Boeing shares are under pressure this morning, down nearly 2%, on pace for their longest daily losing streak since August if today's losses hold. Phil LeBeau has been tracking all the action and joins us with the latest in the share sale there. Phil?
Hi, Deirdre. You know, this is a capital raise that is a little larger than many people were expecting. Remember, they basically got approval to go for anywhere between $15 and $25 billion, and most thought, oh, well, they'll probably do around $15 billion. The total, $18.9 billion. There's a stock sale that makes up $13.9 billion of that. Then a convertible preferred share sale, that's the other $5 billion. Also, which we don't mention here, is there's about another $2.5 billion for over allotment for the underwriter. So you could be looking at something north of $21 billion. For Boeing, this is all about getting as much liquidity and support for the balance sheet as it deals with a couple of issues here. The main one that they're focused on right now, aside from the strike, which is clearly they want to get that resolved as quickly as possible, but they also want to make sure that their credit rating remains industrial grade. All of the credit rating agencies have essentially said, look, you're in jeopardy of going to junk status if the situation deteriorates. Total debt at the end of the third quarter, $57.7 billion. Meanwhile, in terms of the strike, they haven't got any progress to report this morning. If they're talking, and they may be talking, we know that the machinists talked with the acting labor secretary over the weekend. We don't know of any talks that are formally scheduled, but that doesn't mean that there's not some communication going on. 46 days into the strike, remember, it's expected to cost this company at least $1 billion per month. As you take a look at shares of Boeing, remember the loss in the third quarter was more than $6 billion, and they're going to be losing cash in the fourth quarter, losing cash early in 2025. The question now, guys, is you put this equity raise together, you now have the liquidity in place to deal with an extended strike. But as we know, the job number one for Kelly Ortberg and his team, get this strike resolved.
Phil, we mentioned on Friday some of the reports of furloughs at suppliers like Spirit. Do those, you think, stay intact until we get back to the table?
I think so. I think that, and you're already starting to see this from a lot of the smaller suppliers, and it's not getting a lot of headline news because you're looking at maybe a smaller tier 2 supplier that has to let 4 or 5 people go. And that's cumulative. And then when you look at Spirit, clearly, they're the fuselage maker, and at some point, they're not going to continue employing people if they're not making the fuselages because there's not the production happening in Renton. And it's going to be a lumpy, remember what Kelly Ortberg told us, it's going to be a lumpy ramp up in production. You just can't flip the switch and say, come on, everybody, start sending us the product immediately, we're ready to go. It may be fits and starts, at least initially, once they get this strike resolved.
Yeah, you know, Phil, they're not going to have any trouble finding people to buy this, as I reported earlier, as much as $30 billion in demand, a lot of what we call reverse inquiries. That's funds sort of saying to Goldman Sachs and others who are underwriting this, we'd be interested. Many firms were wall crossed, so that's not going to be an issue, which is a good thing. But the dilution is very significant. I mean, you know, where are we in terms of when things get back to normal, the earnings power and the power of this company to deliver free cash flow in 25 or 26?
Second half of 25, you may see some positive free cash flow, depending on two things. One, how quickly they get the strike resolved, and two, how quickly they can move to, first of all, stabilize production and then start to gradually increase it. Remember, 737 MAX production is capped at 38 per month. And Kelly Ortberg told us they were getting close to that point when the strike hit. So theoretically, if you could stabilize, let's say through the end of this year, into the beginning of next year, if the strike gets resolved relatively quickly, and then build production, they believe that they can get the free cash flow, start to generate free cash flow in the second half. Carl?
Phil, huge story. Thanks for helping viewers understand it better this morning. That's our Phil LeBeau. Let's get a news update this morning as well with our Silvana Hanal. Hi, Silvana.
Hey, Carl, good morning to you. The head of the CIA and the Israeli spy agency Mossad are meeting today in Qatar to reignite Gaza ceasefire negotiations. One of the options on the table is an Egyptian plan that would pause the fighting for 2 days to allow for the exchange of 4 Israeli hostages and some Palestinian prisoners. Meanwhile, Israeli forces withdrew today from one of northern Gaza's last functioning medical facilities, claiming troops detained 100 terrorists, including some that disguise themselves as medics. Gaza's health ministry claimed the troops detained hundreds of patients, medical staff, and displaced residents seeking shelter at the hospital. And the Philadelphia District Attorney's Office sued Elon Musk's Political Action Committee today over its $1 million a day giveaway. The lawsuit warns the swing state voter registration sweepstakes could violate federal law. Musk has donated tens of millions of dollars so far to Republican nominee Donald Trump's presidential campaign. David, I'll send it back to you.
Silvana, thank you. Still to come, the election impact on the semiconductor industry. We'll have more on some of the key names and what the reactions may be. Quick programming note as well. CNBC delivering Alpha Investor Summit. It's just a couple of weeks away. It's right here in New York City. November 13th is the day. I will be moderating a panel with Ben Affleck and Jerry Cardinal of Redbird. We're going to talk about the future of media, as you might expect. Both those gentlemen have significant thoughts about that topic. Other speakers also include David Einhorn, Nelson Peltz. Oh, there's just so many. You can go to cnbc.com/delivering alpha or scan that QR code on the screen. We're back in a moment.
Welcome back to Squawk on the Street. On Semi, the latest chip name to report top and bottom line beat, but they do guide lower for Q4 on some weakness in autos. Shares have been an underperformer on the year. You can see down almost 13%, trying to rebound some of that, up 2% this morning.
Yeah, bit of seesaw there after some kind of negative comments on the conference call, at least on about the end markets. Just 8 days to go until the election, and some warning that chip companies and their stocks could take a tumble under one candidate. Let's get to Seema Modi, find out who that is and why. Seema.
Well, David, former President Trump reiterated his frustration with Taiwan, accusing the country of stealing America's chip industry on Joe Rogan's podcast over the weekend. Trump, he criticized the CHIPS Act and said if he were to become president, tariffs were coming for Taiwan's chips, including the bulk of NVIDIA's cutting-edge GPUs. He also suggested foreign companies should not be able to enter the U.S., borrow money, and build chips here. He's, of course, referring to Taiwan Semiconductor that produces about 90% of the world's cutting-edge chips. It's on tap to receive over $6 billion from the U.S. Commerce Department to build and continue to build its Arizona fab. Mizuho writing that last week a Trump win would be bad for Taiwan Semiconductor, while strategists at Citi are debating just how much tariffs will increase costs across the entire chip supply chain. Back in July, when Trump made similar comments, the SMH ETF lost about $675 billion in market cap that week, while U.S. companies building fabs here, Global Foundries, Intel, and Texas Instruments, outperformed. But a Harris win doesn't mean an all clear for the semi-trade, according to experts we spoke to. Remember, some of the harshest export controls on China were implemented under the Biden administration that dramatically impacted how much NVIDIA and other chip companies were able to sell into the country. And guys, both Trump and Harris are expected to ramp up those very restrictions.
Yeah, it's a fascinating
Foundries,
story.
Intel,
so many different
and
angles
Texas
of
Instruments
it, especially I know you
outperformed.
saw that report last week that TSMC's Arizona chip plant yielded more than its Taiwanese equivalent, but of course it's a Taiwanese company, so it'll be interesting to see how this all plays out with Intel too. Seema, thank you very much. Yeah. We also continue to monitor the market cap battle between NVIDIA and Apple. Let's unpack the chip sector further with Bernstein semiconductor analyst Stacey Rascon. Stacey, it's great to see you. NVIDIA doesn't report until kind of late-ish November, but of course we have so many signals this week, right? With CapEx from some of the Mag 7. What do they need to show us to keep the NVIDIA party going?
Look, they just need to show us that demand is there and strong and ideally growing, right? I mean, the big concern there's a number of concerns when anything runs this much, but I mean, the biggest concern has just been sustainability. Like, the numbers have gotten so big so quickly, you just worry that it can't keep going. And like, as of right now, from everything we can see, it looks like it's still going. Like, I get the nervousness. It clearly is not time to worry this year. I don't even think it's time to worry next year. We'll see as we go farther out. But I think at this point, they just need to show that demand is strong and growing and accelerating. And at least from where we're standing right now, everything we can see, things look pretty good, I think.
Right. Stacey, I want to ask you about the story that Seema was just talking about, and that is the idea that Trump especially, but perhaps both candidates would crack down on manufacturing of chips inside of the U.S., but what we've seen from TSMC versus what we haven't seen from Intel. Sort of talk about that and what it would mean if TSMC wasn't able to ramp up here in the United States.
And it's, look, I'll be honest. So I heard Trump's comments as well, and he was, what did he say on Rogan? He said he didn't like the CHIPS Act. He wanted to replace it with tariffs. Yeah. I mean, it makes, look, it's Trump, so Trump is gonna Trump, but it doesn't make any sense, right? The idea that like Taiwan has stolen, quote unquote, our chip making abilities is ridiculous. Like that is not true. And like not allowing foreign companies to make chips on U.S. soil, that is actually what we want. I mean, look, the whole, like the idea that we are dependent on Taiwan and that is becoming increasingly an untenable situation is very true. And, you know, we want to get leading edge infrastructure built here in the U.S. And to be honest, from a policy standpoint, it really shouldn't be mattering all that much who is building it. I understand why Intel is sort of named the national champion, but if the goal is really to get as much leading edge capacity built here as quickly as possible, we should be giving the money to the folks who can build it. And as of right now, that entity is TSMC. And you're right, you know, there was some news flow of the last week that suggested that their yield ramp in Arizona is actually exceeding targets and maybe even exceeding what they do in Taiwan. There are no other players, neither Intel nor Samsung, that can make claims that are anywhere near that. So if the goal is to build the capacity and get it here and installed and running in the US to de-risk the supply chain, that's happening right now. And so stopping that would be a problem, sure.
Have we given up on Intel then?
Well, we'll see. They report earnings on Thursday. I guess we'll see what they have to say. But I mean, clearly, you know, Intel's core business is under pressure. They're losing share, and they can't rely on their own manufacturing right now. So they're actually outsourcing more, which is impacting gross margins and everything like that. So they are Their suggestion is that they believe their process robot overtime is getting fixed. They're going to bring that volume back into the U.S. and it's going to make everything, wonderful. I guess we'll see. They had a day a few months ago where they were sort of giving out some targets for where they thought things could go over time, and it really was like a 2030 story, right? Even if they are on track, like it's a slog between now and when we would actually see things really start to improve. And as of right now, we don't actually know if they're truly improving or not. So strap in for Thursday, I guess. It'll be entertaining, if nothing else, I'm sure.
Yeah, we're not going to get NVIDIA for a little bit, Stacey. But, every so often you hear, I'm sure you do it more than I do, well, there's, a small company over here that's developing a next-generation chip that's going to ultimately disintermediate or push NVIDIA to the side. I mean, how long is their dominance, do you think, going to last?
Well, I mean, there's always somebody in the wings. This is an enormous market, right? The idea that there's not going to be others trying to take a piece of that pie is ridiculous. Of course they are. Now, that being said, like NVIDIA's built up their position in silicon and hardware and software and systems and ecosystem over 10 or 20 years, right? And they put those moats into place. And so anybody that is trying to get in there, and I'm not talking that people can't get little bits. Clearly, AMD and others are getting little bits, but to be like material in that market, you've got to like penetrate those moats, and it's a very, very difficult thing to do. And especially for a startup, I mean, when you just look at the amount of money that NVIDIA has to invest in these things versus smaller, very small companies, it's tough. It's very, very tough. So at this point, I'm not terribly worried about some young upstart coming in and taking a massive amount of NVIDIA. So I'm not even really that worried about larger companies, larger competitors going in and trying to take it. Doesn't seem to be impacting them very much.
Right. Maybe bits and pieces. That tracks with what I hear from tech investors in San Francisco as well. Be interesting to see Cerebras go public. Stacey Rathgod, thanks as always for your insights.
You bet.
Meantime, while surveys show a small percentage of undecided voters in the election, there may actually be more up for grabs than it first appears. We'll get some details on that after a short break.
Have to go for the green.
The U.S. dollar is heading for its largest monthly gain in 2.5 years against a basket of major currencies. One technician thinks there's even more upside ahead in the near term, but the long-term trend is more uncertain. Find out why and what potential strategies there are to capitalize on that greenback. Tune into our Market Navigator segment later on today.
I'm not going to throw Joe on the bus, but he's not a great salesperson. Donald Trump is saying the stuff that's not true, and you know the old saying, you repeat a lie enough, people will start believing.
How much do you think we can rip out of this wasted $6.5 trillion Harris-Biden budget?
Well, I think we can do at least $2 trillion.
Yeah!
Yes.
$2 trillion.
That was Mark Cuban, and then Elon Musk speaking over the weekend. Musk making the case for $2 trillion in cuts to the national budget, and former President Trump also appearing, of course, on the Joe Rogan Experience podcast late Friday, claiming Google CEO Sundar Pichai called him personally to tell him that his stint at McDonald's was, quote, one of the biggest things we've ever had on Google. It just hit. I did hit up a few people at Google to try and confirm that. Haven't heard back, though. All that said, it's just 8 days until the election. It could all come down to those who have yet to make up their mind and getting out the vote. Senior economics reporter Steve Leisman with fresh insight into who those people are, Steve, and how they might vote if they vote.
Yes, Deirdre, we call them the persuadables. Sounds like a political sitcom. This is the group of registered voters in our poll of 1,000 nationwide who are either undecided or have told us they could yet change their mind. And there are more of them than you'd think at this late stage in the race. Take a look at the numbers here. 16% of all voters nationally are quote unquote persuadable. That's 6% undecided, and 10% over here, they could yet change their mind. Now let's look at who these people are. If you look at it by who their preferences, 87% of Trump voters say they'll definitely vote for Trump, but 12% say they could change their mind. For Harris, 92% say they'll definitely vote for her, but 7% are on the fence. 13% of those in the 7 battleground states are persuadable versus 16% nationally. They are more Republican. That's bad for Trump and good for him if he could bring him home. 45% are men, but 53% are women. Harris does better with women, so that's good for her. 30% have a high school education or less versus 22% college grads. That's good for Trump. That's his group, but he's got to bring them out. It points to the importance of this get out the vote efforts. Tens of millions being spent on both sides. Trump has a 37-point lead. Check it out with blue collar workers. But 18% are in what we call the low interest or low intensity voter. He has a big lead among the poor and working class. Again, a low intensity voter. Same with high school or less. Voters of color, Harris plus 27, but again, a low interest voter. So it all comes down to this question. The election comes down to whether Harris can get more of those persuadable women to her side and voters of color to the polls. For Trump, it's about keeping those persuadable Republicans on his side and getting blue collar workers to turn out. And it all has to happen the most in the battleground states. Carl and the gang, this is why Trump was at McDonald's. This is why he was on Joe Rogan. This is why Harris continues to campaign in the cities. All of this data tells you why and where they are for the last several days of the election.
Turnout, I guess, said another way, right? That's sort of where it all is focused right now, Steve.
Exactly, David.
I wanted to get your quick take on that that exchange that we had there between Musk and Howard Lutnick. $2 trillion out of the federal budget, $6.5 trillion roughly, maybe a bit more than that. I mean, most of that's non-discretionary. Most of it's Social Security, Medicare, Medicaid. Do the numbers in any way equate to the possibility of cutting $2 trillion?
That depends on what you consider the possibility. I can cut $5 trillion out of the budget, David. I could do it tomorrow. The question is, would I remain in office or cause a revolution among, for example, your Social Security recipients, your recipients of different parts of the federal pie? It's easy to cut. It's hard to do so politically. There are all sorts of things. Whether or not you could sort of get the fat out.
Pain brings no pleasure. Your pain brings no pleasure. So little accomplished. Worth collecting. Worth collecting. Worth collecting.
Okay, so part of the A shares up about 27% year to date. Walk us through the actual trade for Cameco, Mike.
Yeah, so we do have earnings coming up. And so what I want to do is that I want to buy the November 8th implied volatility, because that's going to hold up no matter what happens. No matter if we go up or down from here, that's going to hold up. I do like the bullish play. And so I'm going to do a November 8th versus November 1st, 58 call calendar, just a little bit south of 52-week highs, but you can get that for a really, really cheap price, like 60 cents. And if we rally due up to that 58 strike coming up on November 1st, then, you know, we're looking at a reward. It's about a 1-to-1 play for a calendar like this going into earnings. It could, I did not model it higher, which I actually think that the IV could be higher, which would be good for our spread. But I do like that even as a 1-to-1 play. Just a little short play pre-earnings, and I have no intention of holding this through earnings.
Okay. All right, Rick, moving over to you. When you take a look at the chart, obviously Mike said he likes the technical play, also likes the fundamentals here. What stands out to you in terms of this chart? Because if you only look at September to now, it looks pretty good. But you know, earlier this year, it wasn't necessarily the case.
Yeah, what stands out is the huge drop-off that we saw after we hit the highs back here around April, May, around that time. Very steep fall off here, kind of this W-shaped price pattern that took us all the way back up to where we were before very quickly, and then some. We actually crossed above our previous high point. We made some new 52-week highs, 58.72, lining up pretty closely with the strike price for our trade, by the way. So basically looking for us to exceed those old highs here. But now we've kind of faltered once again here. We've fallen off a little bit. We've retreated to what looks like an important area to me. You can see the area between our dark green and light green lines here, between like 52.45 to 53.05. That was the low point that we had after a small gap up. That's about where we held on the past couple of trading days here. However, RSI interrupted, trending lower below the overbought area. You can also see that our trend line, our kind of very narrow, very steep white channel here has been broken. However, today's candle is kind of throws things for a loop though. Very big bullish engulfing candle. Today's big green candle completely swallowing up the tiny red candle from the previous day, which was also kind of almost a doji, like spinning top type candle, where it opened almost where it closed. So big move up today. Look for upside follow through, resistance right here at our old highs near 56.24, and then those previous highs to the upside as well, with the supportive area that I mentioned on the bottom, bolstered by the 21-day EMA in yellow, 52.48.
Okay, so bullish engulfing candle there. All right, Mike, let's move on to your next trade, United Health. Not as impressive of gains year to date, only up about 7% so far in 2024, but walk us through why you're trading this one.
So I agree. And this is a sit and hold type of trade that I don't see a whole lot of direction either way. But I do like us to just hold in this range, and that's why I'm looking to sell an iron condor. I'm looking to sell implied volatility, and we can move a little bit up, we can move a little bit down. Hopefully we stay right here, but that would be the play for UNH right now.
Okay, so walk us through the actual trade, this kind of sit and hold type trade.
So what I'm looking for, November 8th, 550, 555 on the put side, because an iron condor, in this case, we're selling a put spread, we're selling a call spread at the same time. So the 550, 555 put spread, and then we're going to sell the 590, 595 call spread in the hopes, you know, we don't hope as traders, hopefully, but the best outcome would be for us to sit there in between our short strikes, and then we're risking on this one, if we can sell this for $275, each side is $5 wide, so I'm risking $225 to make $275, and that's a risk return of 1.22 to 1. So it's a sit and hold, and hopefully we don't do anything in between now and November 8th.
All right, so you don't want to see a whole lot of market action here. Basically, what United Health is doing right now, doing a whole lot of nothing, essentially flat today. Rick, when you take a look at the charts, what do the technicals tell you? What stands out?
The first thing that you'll probably notice is we had a pretty big drop off on this chart during our last earnings event. The other thing is that before we had the drop off, we topped out at the same point twice, a double top near those 52-week highs, right around 608 or so. So that was a pretty discouraging development for the bulls here. Nevertheless, our longer term white trend line here, starting with our 52-week lows near 436, is actually still intact for now. We do have a very short-term blue trend line here going down across the high point that we reached after we had our gap down. So we kind of made our way back to this previous low point, but we're nowhere near filling the gap. So a little bit of upside progress here has been kind of losing steam here. We are below our moving averages, yellow 21-day and orange 63-day, both trending downward here. So I think what maybe would kind of worry me at this point, if I were interested in making some kind of play on this name, kind of this situation of I drew that wrong. Consolidation here, kind of this like pennant type shape here where we had a big gap down, a little bit of a pullback, and then some consolidation. I would be worried like a bear flag, bear pennant type situation where we would take out these previous lows and continue down further here. So that low point, 543, green line here. Then we had a repeated ceiling here that we eventually did break through our light green line near 529 with purple 252-day EMA in between.
Okay, all right, and Mike, your final trade is Upstart, UPST, shares up about 2% today. Tell us why you're trading this one, another one that reports, I believe, November 7th here.
Yeah, November 7th, and so what I'm looking for, this has been one of those that it was a laggard as far as the rest of the tech companies, but the interest rate environment is friendly for them, and I'm looking for, this is actually a play up again into, not including earnings, that we're going to see a run up into there if we can get that pullback there. That the trigger price here for me is 49.92. That would be what I call a hull reversion. We got there this morning, bounced exactly, I don't want to say exactly, almost exactly off of that. And so I'm just seeing a continued uptrend into earnings, and we're going to play this with a call spread. Maybe we get some exuberance going into there, but I do like these kind of laggard type of fintech stocks going into earnings.
Okay, yeah, wow, good point here. If you take a look at the month-to-date performance for Upstart, up about almost 30% in October. Pretty impressive run higher. Rick, what stands out to you from a technical standpoint?
So looking here, we can see, once again, we have a trend line coming from a notable low point. It was not necessarily the 52-week low, but very close. We kind of bottomed out around the same point a few times here. So right around that level, near like 1990 or so, we've had a big rally up from that point. White trend line still in play going upward, but also we've kind of moderated a little bit here. We topped out at 57.40, kind of trending downward now. The crucial thing to be watching today is our blue trend line. It's a steeper trend line. It's shorter term. We're right on the verge of possibly breaking through to the downside here. And we are off about 10% from those highs that we reached here. So a bit of an interruption in this trend. And we can see as well RSI trending downward here out of the over overbought area. Still bullish, but for sure losing steam. Now we can also see that we have a couple points to watch. A repeated high point is our dark red line, 54.40, and then our pink line, the intraday high point, 57.40. To the downside, we have our gap to watch. The post-gap high point post-gap low point and the pre-gap high point. That area in between is where we're looking at. 47.35 to 48.54 with our yellow 21-day EMA in between, so a support zone there.
Okay. All right. So still bullish, but losing steam. Mike, want to give you a quick chance to actually walk us through the trade. You gave us the cliff notes, but tell us more of the details here.
Yeah, I think we're on the same page here. I'm looking from that pullback from the highs and then a run up into earnings. So like I said, 49.92, we're a little bit higher than that. We might have bounced off of that this morning, but I'm looking at the 53.58 call spread. And if they want to run it up, then we can get that in. This morning, we could have got into that for about 85 cents, and it's a $5 wide call spread. So we can make $4.15, and I'm only risking 85. That is 4.88 to 1. That's my more aggressive play for the day.
All right. It's currently trading at 51.67 right now. Mike Shore, Prosper Trading Academy, and of course, Rick Ducat. Thank you so much for being here. Coming up next, we're going to spotlight Apple as the company begins to roll out its Apple Intelligence features today. We'll find out if it will live up to expectations, which are pretty high. More next on Trading 360.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage. Insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device. For free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Caroline Woods, filling in for Nicole Patalides, live from the floor of the New York Stock Exchange. It's time to spotlight Apple as the company begins to roll out artificial intelligence, or Apple Intelligence, I should say, today. Joining us now to discuss is Ed Bukowski, managing partner at Chapwood Investments. Ed, great to have you on the show. Thanks for joining us.
Well, thanks for having me. I appreciate it.
So Apple shares higher today, up almost 1% right now, only about 1.7% away from the highs. Of course, it's also earnings week on Thursday for Apple. So investors appear optimistic. Do you think it's warranted?
Well, I'll tell you, the Apple Intelligence is being drifted out in stages. So only iPhone 16, 17, and then 18 or 17 is going to have Apple Intelligence along with the iPads. So I've never really seen Apple come out and roll things out in stages like they are. So I don't see there being an immediate reaction to earnings for this. Although I'm sitting here with an iPhone 13, so I feel like I need to step it up and get an iPhone 16 now just to participate with everybody. But the Apple Intelligence is going to allow you to edit photos, consolidate messages. And so not just taking, a number of messages, like my wife gets a ton of messages from her tennis team. She can now consolidate all of them and use AI in order to interpret all of them instead of having to read each one of them off. So that's good. And it's also going to be good for the iPads that are being rolled out. So, but the more important story is the earnings. And earnings for the last quarter are supposed to be pretty, much in line with all other quarters or their previous quarters. So they're looking at $1.55 per share on $94 billion in revenue. And this is supposed to be in line with everything else. And we have target price at $240 on the stock.
So I guess my question is, 240 is what, $6? And 50 cents away from where it currently is trading. So what gets it to 240, and what would make you more bullish and increase your price target? How much of that has to do with demand for iPhone 16 and these Apple Intelligence features?
Yeah, well, a lot has to do with it. It's all about what's going to happen, not what has happened. And Apple is not immune to that. So even though it's pushed up, really good numbers, we're still looking for something to really catapult it to the next level, and that's going to be sales. And sales are always going to drive, obviously revenues. But there's also a discussion about something that happened in Indonesia today, where the Indonesian government has halted Apple sales, and they're the fourth most populous country in the world, and they've halted Apple sales because they're not deriving a lot of the parts from Indonesian manufacturers. So this could be something that's going to happen globally. So this is, again, that's something that could hurt earnings and earnings forecast for Apple. So I'm not that much of a bull on Apple unless they go ahead and increase their dividend. I mean, their dividend is only 0.43%, $1. And they create so much cash that I would love to see Apple increase their dividend. That would get a lot of people investing in the company.
And you're expecting basically inline results from Apple, but I think the fact that it is up more than 20% year to date, it is trading so close to those highs. We've seen with a lot of these companies, even if they beat, doesn't necessarily mean good things for the stock. So do you think that Apple, just in terms of its positioning heading into this report, is setting itself up possibly for disappointment for anything other than, blowing past expectations?
Yeah, I don't think that Apple is going to have a blowout quarter where they're going to really do much better than what is forecasted. They don't normally do that. So I really believe a lot of it is going to have to do with the Apple Intelligence and how they make money as a result of it. And right now, the only way I see them making money is by selling more products, not by creating any revenue off of existing products. So they're going to have to go out there and sell a lot more iPhones and a lot more iPads. Now, there is talk about them coming out with a new Mac Pro, which again, is more selling of products, and then that has to be questioned as to what the margins are on those. But the Apple Intelligence alone is not going to create revenue. It's going to create some hype and some interest, but it's not going to create revenue by itself.
Yeah, and based on what we've been hearing from the wireless carriers last week during earnings, it doesn't seem like people are as willing to upgrade. We might say we are. You have the 13, I have the 14. But neither of us are rushing out to actually upgrade our phones. That all being said, especially given that your price target on Apple isn't, it's higher than where it is, but it's not all that bullish. What is the role of big tech just in terms of market action between now and year end? Do you think tech will continue to move this market higher, or do you think that we're going to see potentially no gains, or do you think we're going to continue to see this broadening out?
Yeah, I think we're going to see a broadening out from the Magnificent Seven. I think a lot of the smaller growth stocks, a lot of tech and a lot of biotech stocks are going to do well towards the end of the year. And my favorite are utilities. I think utilities are poised to do really well, but I don't believe tech is going to lead the way. Even though they're the biggest market cap stocks out there, I just don't believe that MAGA tech stocks are going to lead this market higher. I think it's going to be a much more broadening out across all different disciplines.
So what does that look like in terms of market gains between now and year end? Quite a bit more muted. Ultimately, do we end higher than where we are right now?
Yes, I absolutely believe we're going to end up about 10% higher than where we are right now. I think once the election is over, we're going to have clarity, and with clarity comes a lot, stronger opinions, and I think those opinions are going to be for growth around the world. I think we're in a really good situation with lower interest rates and earnings coming in pretty strong, and the tech stocks are going to do well. I just don't think they're going to lead the way. I think consumer products are going to do very well as we see an opening around the globe with emerging markets, and Asia is going to do well.
Any of the Mag 7 that you'd be comfortable buying at these levels right now?
I like Meta. I've always liked Meta. I like the way that they grow their business. I like everything they're doing, and I like how they're cutting back on their metaverse spending, where they're able to get back to basics. So I really like Meta quite a bit.
All right, and Meta is severely outperforming the broader market, up more than 60% year to date. Ed Bukowski, Chapwood Investments, appreciate your insights. Thanks so much.
Thank you.
All right, coming up next, time for the Disruptor. It's George Sillis. We'll take a look at L3 Harris after analysts raise their price target after earnings. He'll give us the details and an example trade next on Trading 360. We'll be right back.
On the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome back to Trading 360. I'm Caroline Woods, live from the New York Stock Exchange. For a look at developing stories this morning, I'd like to bring in Alex Coffey, senior equities contributor here on Schwab Network. Alex, you're taking a look at Delta shares this morning. They're up about almost 4% right now on this news that it's going after CrowdStrike, which shares of CrowdStrike also higher today. So fill us in.
Yeah, a couple things going on. I think the big story, though, is, as you mentioned, Delta filing suit in Georgia courts against CrowdStrike in response to the outage from back in July, of course, that basically took down Windows systems across the world, one of the biggest, if not the biggest, IT outages ever. But as a result, Delta is filing in court, as I said, and asking for damages in the amounts of over $500 million, resulting in losses and punitive damages. Delta, within its complaint, accuses the cybersecurity software vendor of breach of contract and negligence after the outage. They said that they caused a global catastrophe because it cut corners, took shortcuts, circumvented the very testing and certification processes it advertises for its own benefit and profit. As a result, as you said, you perhaps see a little bit of a bid into Delta Airlines stock. I could also note that crude oil down, 5-6%, probably adding to that bid as well. You did see CrowdStrike shares under pressure initially after the open, since bid back up and slightly higher here in real time. So what we do know is both sides will likely hash this out for a while, and ultimately will have resolution. But probably not something that's going to happen overnight.
Yeah, good point, Alex. I think if you take a look at some of the other airlines surging higher today, as well, it could very likely be because of the drop in crude prices. American Airlines up 5% today. Delta, United, Carnival, Alaska, up almost 4% today. So a good day for the travel stock. Alex. Coffee, thanks so much. All right, it's time now for the disruptors. George Sillis, senior markets correspondent, is here with today's company, L3Harris. Shares lower today, but did hit 2.5-year highs after earnings, and several price targets are being raised. George, so fill us in. What's behind the calls?
Yeah, there was an earnings call for L3 on Friday, and the stock is just pulling back a little bit. You're right. I mean, it's been a great performer, up over 40% over the last year. One of the things about this company is I'm looking at aerospace and defense, which this company is, as more recession resistant. Irrespective of who's in office, either Democrat or Republican president, they're going to be spending quite a bit of money on defense spending going forward. And this is a company that's really a critical component of mission control systems, intelligence communications, as well as integrated missile systems. And they also provide weapons guidance systems and things like, infrared vision technologies for soldiers. So it's a really interesting company, both communications and missile guided systems. When they reported earnings, sales were higher by about 8%. They actually beat the estimates for earnings. They did increase their guidance for both revenue and earnings for the full year. And the stock is pulling back a little bit. And I think there's some concerns perhaps based on the stock being fairly valued. If you look at the earnings estimates or EBITDA growth estimates going forward at around 10%, historically they're around 11%, but the stock is trading just slightly higher at around 18 times forward earnings versus 17 on a 5-year average. So what I think is happening here with some of these analysts, for instance, Morgan Stanley, they did increase their price target to 275, but they maintain an equal weight rating on the stock. RBC also maintains sector perform on L3 Harris price target 265. The reason being is I think they're seeing the stock as fairly balanced and fairly valued, but nonetheless, the stock did close near the low on Friday, and this is commensurate with the market, which again, closed near the lows after a pretty good start to the day. But the stock is pulling back just slightly today, and I think it's based on some market performance.
Okay, so the highest price target on the street is 324, although that hasn't been adjusted in a while. So some of those price targets imply a little bit of upside, but not as much as some of the more bullish ratings. The median price target now 270 for L3 Harris, 60% of analysts in the buy camp. So all of that being said, and based on earnings, walk us through an example trade for L3 Harris.
Yeah, so what I'm going to do in this case is I don't expect a lot of movement. The stock doesn't trade a lot of volume, but it's still in a positive uptrend, and I think the trend will slowly continue. But one of the things about this stock and many of the other aerospace and defense companies like General Dynamics and Lockheed is they pay sufficient and very generous dividends. So in order to participate in the dividend, we will obviously want to buy stock, and that dividend is about $4.64, or about 33% of their total earnings. So what I'm going to do in this case is I'm going to buy stock, around $251, and then I'm going to actually go out to the December contract for calls. I'm going to sell a covered call against the stock position. So by selling the 260 out of the money calls, you can actually harvest an additional $4 a share or $400 a contract. So essentially what this does is if you buy the stock at 251, sell that call for $4, it lowers your stock position cost basis to $247. But again, it enhances the position because you're earning about $4 per share between now and expiration. And you get to keep the shares, assuming the stock doesn't trade above the short strike, which is 260 in this case. But essentially, you still have long stock position risk, but it does reduce your cost basis on the total position to $247.
Okay. L3 Harris currently trading down about 1% at around $250 right now. George Sillis, thanks so much. All right, coming up next, it's time for our 360 round. We'll be taking a look at onsemi after earnings. Shares are slightly higher, actually picking up some steam. They were slightly higher. Now they're up about 5% after earnings. We'll break down those Numbers next on Trading 360. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly. with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No. Can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help. However complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome back to Trading 360. It's time for the 360 round. We're talking On semi after earnings. Let's bring in our panel. Angelo Zeno is Senior Equity Analyst at CFRA Research, and Michael Robinson is Chief Technology Strategist at Weiss Ratings. Great to have you both here, Angelo and Michael. Michael, let's start with you. Shares of On Semi higher today, up about 5% after this report. It was a top and bottom line beat. What stood out to you?
Well, it was a beat. They did beat forecast, which is awesome. But I just feel like this stock is way too choppy. This is the most, I mean, I'm looking at the chart right now and I'm getting dizzy looking at it. And so that just tells me neither the bulls nor the bears are in control. They've had 2 quarters in a row of negative earnings growth that were down 27% in the most recent period just reported, and down the quarter before that 28%. And I like to see, earnings growth, particularly in this market and this economy. They do have a good portfolio of great products, but I just don't think they're performing all that well. And there are other things out there that I like a lot better. So I would not, today's report isn't a reason to sell, but it's not a reason to buy.
Okay. All right. And good point there. In terms of, if you take a look at the revenue numbers, Power Solutions Group down 23%, Analog and Mixed Signals Group down 16%, Intelligent Sensing Group sales fell 15%. So a beat, but important to put those numbers into perspective. So Angelo, similarly, you're sticking on the sidelines with your hold rating, $80 price target for On Semi after earnings. So certainly not any more bullish following this report, but anything in particular stand out to you?
Yeah, so I mean, I think overall, in terms of a sentiment perspective, I agree with Michael. I'm kind of in a stance where, this is a company where they're kind of undergoing some pretty tough times right now in terms of some of the more cyclical markets. About kind of 79-80% of their revenue really tied to industrials and autos, which is okay because we do think you're going to see some sort of cyclical trough here at some point here over the next kind of, let's call it 2 quarters or so, if you haven't seen it already. And you can kind of see how Texas Instruments reacted last week after they reported, and the stock kind of picked up on a miss. But that said, you kind of look at on the reason we're on the sidelines when it comes to this name specifically is because of their silicon carbide exposure. We're very concerned about that business generally, and the biggest reason for it is competitive pressures are increasing out there, specifically out in China. When you kind of look at the 2 biggest markets out there that silicon carbide kind of caters to, it's essentially the EV market as well as the solar markets. 2 markets where China has really kind of ramped up their kind of production on that side of things. So we think it's just natural they're going to continue to get aggressive on the silicon carbide side of things, and that could potentially pressure pricing in some of their contracts in the future. So we'd rather play names within kind of the auto industrial semiconductor markets that are not necessarily tied to that silicon carbide theme right now.
Okay, and I want to get both of your picks outside of, because it's certainly not on semi, in just a second. Angelo, sticking with you for just 1 second, though, because I think it's important to note, shares, of course, were under pressure heading into this report, still down about 11% year to date. The CEO on the earnings call did talk about power demand continuing to rise and talked about gaining market share in automotive, industrial, and AI data center. How does AI play into an on semi? Certainly hasn't been a positive catalyst at this point. Do you expect it to be in the future?
Listen, I think it's an important market for them, like it is for kind of other chip makers out there. They're not as exposed to kind of the AI theme out there as other semiconductor names out there. So it is kind of an important kind of potential growth catalyst out there for the company. But again, it's not something that necessarily is going to lead to some sort of kind of massive upside revision in terms of kind of the growth expectations out there. I earlier kind of alluded to the fact about 80% of their revenue tied to autos, industrial. So in order to really kind of see a nice recovery within their business, a nice cyclical upturn in 2025. And into 2026, it's going to be more dependent on the fact that, you kind of see some greater momentum on those type of end markets out there. And listen, the visibility specifically on the industrial side of things is very, very tough. You're talking about thousands of customers out there. It's very fragmented in nature, unlike other markets, to your point, like cloud or wireless, where you kind of have a couple of big players out there. This is it's a lot more difficult to kind of call bottoms in areas like industrials out there. But that said, yeah, it's an opportunity for the company. It's just not as massive as, other plays out there within the semi space.
Okay, so Michael, going back to you, the chart is way too choppy for onsemi for you to be a buyer. What do you like better than onsemi that you'd be comfortable putting money to work in right now?
Couple of names. I don't think you can go wrong in the long haul with ARM Holdings. If there's no ARM Holdings, there's no global tech economy, right? There, 70% of the world's population is using some form of ARM-based processor. Big part of the mobile wave and this continued to go on. Right now, they've shipped 287 billion shipped so far today. So I don't think you can go wrong with Broadcom for the long haul. And another play that I like, and it's, in this AI era, I think it's also going to do very well. Another company that can benefit from the AI inflection point that we've seen the last several quarters would be Avago, Broadcom, AVGO is the symbol. Big play on high-speed data processing. Their things are so fast, it's almost incomprehensible to the human being how fast this stuff moves. And that's really going to solve a major bottleneck for the AI segment, which is a pervasive. I mean, it's going to be all through the global tech ecosystem AI. So you need these really high-speed interconnects and other things that Broadcom makes. So without that, you're not going to have the kinds of speeds that you need. And so they're a good play on a radio frequency, system on chips, and things like that. So one quick name, if I could say, Arista Networks. Really a great play on AI, good hardware company. They're doubling their earnings every 2.5 years, which is phenomenal. And again, they are a great play on the inflection point in AI because those AI data centers, as I just said, really need high speed transmission because they're just an avalanche of data related to what's going on there with large language models and so forth.
Okay, and in very different charts, ARM's up over 100% year to date, Broadcom's up 54%, and then Arista Network is up about 67%. So Angelo, we only have about 30 seconds left, but want to hear your top picks in this space as well.
Yeah, so I guess I'll go real quick. So if you're kind of looking for more on the auto industrial kind of cyclical play out there, our favorite name there is NXP Semiconductors, tickers NXPI. They don't have that silicon carbide exposure. They're also a European play out there, so they don't have some of the regulatory concerns that you could potentially see coming from the U.S. But the other names that we like, Marvell is strong buy recommendation, like their AI as well as kind of non-cyclical upturn, and then NVIDIA and Broadcom I think are still great plays out there.
Okay, and NVIDIA actually down today, Angelo, down about less than 1%. You'd buy this dip?
We would. I mean, clearly you could wait for a little bit more of a dip given the run they've had right now, but kind of ahead of earnings season, next month we do expect that to be a catalyst, given the fact that Blackwell will start to finally launch. And we do think there's kind of upward momentum to estimates from that ramp.
Okay, we'll leave it there. Angelo Zeno, CFRA Research, and Michael Robinson Weiss. Ratings. Appreciate your picks. Appreciate your insights. Thanks so much. And thank you for joining us on Trading 360. Be sure to download the free Schwab Network app, available in the Apple App Store, and of course tune in 24/7 on schwabnetwork.com. I'll see you back here at 2 p.m. Eastern for the watch list, but stay tuned because Fast Market is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by the numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election
trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the market. Place and sift through enormous staggering amounts of data.
You certainly see pattern. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation. And in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
Companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you. Market Overtime on the Schwab Network. Thanks for tuning in.
And welcome to Fast Market on the Schwab Network. My name is Kevin Hinks. I'll be taking you through the next half hour. I got two really smart young guys hanging out with me for the hour. But before we do that, before we bring in Kevin Green and Alex Coffey, let's take a look at what we're going to look at today. Remember, it's the beginning of earnings season, so we are going to be packed with earnings, looks at earnings, discussions on earnings, and paper money trades on earnings all week and going forward. Today, 3 good ones. We have PayPal, we have Chipotle, we have McDonald's. I've got Kevin Green, I've got Alex Coffey, I've got Landon Swan, I've got George Tillis, all coming on to talk about these markets. But before we do that, let's update the markets. Let's show where the markets are trading here at 11 o'clock Central, 12 o'clock Eastern. The S&P 500, let's call it up 1/3%, 18 points to 5826. Dow Jones Industrial Average up 9/16%, 229 points to 42,343. NASDAQ Composite 100 up 1/6%. 34 points to 20,386, and the Russell 2000, the leader in percentage gainers today, up 1.5%. 32.5 points to 2240 and some change. All right, now let's bring in my co-host for the next hour. That's Mr. Kevin Green, coming to us from somewhere, a remote location in Colorado. Kev, good to see you. A lot to talk about today, Kev. This could be the 4-hour fast market special if we wanted to cover all the data and earnings that we wanted to cover on today's show. Kev, what are you looking at? How do you keep this week in perspective here, one thing at a time?
Yeah, I mean, there's a lot that's coming out here, Kev, as you kind of mentioned. We have some inflationary data happening on Thursday with PCE. We also have jobs week, so we're going to get the JOLTS number tomorrow. We're going to get ADP, and then we're going to have the jobs report on Friday. And we're also going to get GDP. So at the end of the day, I mean, there's a lot in there just for the economic macro-focused individuals. And then we also have big tech earnings coming out. We have Microsoft, Google, Amazon, AMD. And so there's enough there for everybody to really kind of at least try to profit within this market. Now, what I do find very interesting when you're looking at the S&P 500 is that we've had the last couple of trading sessions where we pop higher and then we kind of fade throughout the session. I'm not saying that we're going to do that today, but it does look like we are giving up some of the earlier gains here, and we're not really able to hold. And so I'm also kind of keeping my eye out on the price action and see if the bulls actually have enough confidence and enough strength to be able to break us out of this consolidation that we've been in over the last couple of trading sessions. But what are you looking for this week as it pertains to either earnings or on the economic front?
Yeah, I think that this is going to be, I think on a week like this, with so much economic data, so much earnings, you got to keep your focus short term on what's happening and affecting the markets right now. Like, for instance, crude oil. Right? The trade this morning on crude oil was pretty significant. However, stocks, how do I know crude oil is important? Because the energy sector in the S&P 500 is down, all the rest higher. Right? The world sees lower crude oil as a pretty positive reaction from stocks and businesses across. I want to bring in Alex Coffey, though, for his commentary on this. Alex, on a week like this, I asked Kevin, I'll ask you, what are you looking at?
Yeah, I think you take it day by day, like you both said. I asked you the same question this morning on futures. I guess for me, the biggest thing is that unless you have a really strong conviction on one of the names and you're kind of, okay, stomaching the risk, I kind of look at this as a trader's market. What I mean by that is we're going to get so much information, basically, like every morning, every afternoon for the next 5 days. It's possible that we have kind of like a game of ping pong that goes on where the market's going to be negative on some news, positive on our next, positive on the next one, and it's going to bounce around. And so the more that you can do kind of what you talk about a lot, which is kind of be in the storage business, trade what's in front of you, the more you can take advantage of those opportunities. At the same time, if you do, just as, there's always a caveat, if you do start stacking a few of these events in the same direction, Apple's positive, Amazon's positive, Meta's positive, the job data's positive, you can see a very big move happen this week.
Exactly.
However, what we've seen in these weeks in the past is it feels like we're going to go down one day, and then it feels like we're going to go to the new highs the next day, and it kind of ends up kind of balancing itself out because there's just so much to digest.
Kev, when I think about earnings stories, when I think about these markets during earnings season, it's a big market made up of a bunch of individual stories. We're going to get 5 of the 7 Magnificent 7 names here this week. Kev, tell me which one's the most important, right? I mean, every one is important. Which one's the most important? If you had to pick one name to look at, what would it be? One name in earnings and one data point. Give me those 2, Kev.
Yeah, I would say the big one for me is going to be Microsoft, because it's obviously a big earnings driver. And when you're looking at a lot of these companies here, this is the bulk of the S&P 500 earnings growth that we should be seeing. So if they can actually meet or exceed the street's expectations, it makes the multiples that we're trading at right now a little bit more palatable. So I think that Microsoft number is not only going to show us what's happening in the cloud space, right? We have Azure, not only going to show us what's going to happen in the AI space or what's happening in the AI space. They have Copilot out there. They're really actually already seeing the monetization of artificial intelligence. They're going to give us some information when it comes to CapEx spend that's going to kind of permeate over to the semiconductor space here. And usually their leadership team is not as rosy of they don't really paint a rosy picture when they talk. They're kind of low expectations, making sure the market has a very low bar. So I think that's actually the perfect blend from all of these companies this week. The macro data, I'm looking at PCE. It's in the back of everybody's mind now. You know, no one's really kind of focusing on it. It's been jobs. But if you're looking at the month-over-month print for the expectation for core PCE, the market's expecting that to come in at 0.3%. Last month it was 0.1%. Do we have a positive revision in the last month number? Does it come in a little bit hot on that month-over-month print for core? Do we actually see a little bit of a stagnation or even a reversal and an increase on year-over-year PCE? That's going to be the curveball for the Fed, which we're going to have a Fed meeting next week. So that's kind of the 2 areas or pockets of the market when it comes to earnings as well as macro eco data that I'm going to be focusing on for the remainder of the week here.
So Alex Coffey, Kevin Green has Microsoft and PCE. What's Alex Coffey's look?
It's hard to argue with either one of those, right? And I think everyone's going to be focused on the jobs data on Friday morning, but I'm not going to say that because it's the end of the week. So there's a lot of things that are going to happen before that. Now, my least favorite data point this week is also going to be my answer, and that's JOLTS. Sure. I don't think that JOLTS is the most reliable indicator of the job market, but it's the first one we're going to get. And I think the first number is always important on a week where there's a lot of things going on. Tone setter tomorrow morning. JOLTS is going to be the macro data point I'm going to call out, and it's less so the job openings piece, but more so the labor turnover side of that survey and hires. So quits and hires, I think, has frozen over the last few months. I want to see if that changes at all as it goes forward. And then on the earnings front, Amazon. And the reason being is we get to look into 2 things. We get to look into cloud and kind of tech spend, and we also get to look at what is the consumer buying and how much are they spending. Sure. Both of those things I think are going to be important for the next quarter and then the following quarter.
Subplot. I'm going to stay right here with Alex. You mentioned cloud. Kevin Green mentioned cloud. Amazon, Azure, Google Cloud, all this week. Yes. So we're going to get a really good look at cloud this week because the 3 major players are all coming out with earnings. Stay right there. Your thoughts?
Yeah, no doubt about it. And if you're looking at it that front, maybe Alphabet's the most important because they're the first one. There's really no answer that's wrong if you choose a Magnificent 7 name. You could say Apple because this iPhone cycle is going to be so critical. How they're talking about how that's shaping up in terms of their limited guidance that they provide. I think Visa and MasterCard are important.
There you go,
another way that Amazon will give us a look into the consumer. Right. They're going to tell us things. I don't know that it's even smart to try to narrow it down. I think it's a fun conversation, but really you should be paying attention to as much as you can this week.
It's one of those, Kev, if you're a batter, right, you're standing up there. You're looking for a fastball, but you got to be careful of the curveballs too, Kev. Your thoughts on cloud, on the consumer, on all the things that could help us this week and hurt us.
Yeah, I completely agree. I mean, you need to have the economic calendar as well as the earnings calendar out every single day when you're placing a trade, because you can get caught off guard here. You know, from the cloud standpoint, I'm not sure how much of an impact it's really going to have, because there's a separation between cloud and then AI, right? They're not one and the same. So from the cloud business standpoint, you want to obviously see growth out of all three of those names, but you really want to see Microsoft probably trying to recapture some of the losses that they've seen as far as market share. And then you're going to see CapEx spend, and when it comes to the AI portion. So I think that's going to be key for all three of those names that you mentioned. Amazon for the consumer, I think that's a really good gauge. We are coming into a seasonal period where the consumer starts to ramp up spending because of the holidays that are coming. We'll get some commentary on the conference call to see where they're kind of at within that cycle. If they're already seeing a couple of things taking place, are they going to have more discount days or these prime days that could be a tailwind for them? So they've been able to right size their business, Kev. It's been very difficult if you're looking at an Amazon chart, because 190 has been that area where Jeff Bezos, what everybody's assuming, he's really kind of liquidating at that level. So it's been a very hard wall. But once we kind of break through 190, you could actually probably see this thing squeeze up pretty rapidly. We just don't know when that's going to happen, just because of that structured selling that you're seeing with a very top, a shareholder of the company.
Amazon late in the week. That's Thursday after the bell. But we've got a lot of names coming up before that. And a lot of names, I want to go a little macro today, because crude oil, this move in crude oil, it's once the geopolitical risk softened because Israel didn't bomb energy sites, macro took over in crude oil, and you see how heavy crude oil was down over 6% at one point. Your thoughts? Because, like I said, other than energy being down, all 11 sectors of the S&P are higher. Anyone that moves something from point A to point B is getting helped by these crude oil prices, Alex.
Yeah, and it would have looked way more dramatic than it even did today or yesterday at the open had these strikes taken place while markets were actually open.
Right.
You probably would have seen weakness in equities. In fact, you did see that in some of the ETFs and stocks that were still trading beyond the futures. You would have seen gold likely spike, and you would have seen crude oil probably jump on those initial reports of retaliatory strikes. Once the dust settled, once there it seemed, okay, there's not going to be more, the areas that were struck seemed to be more military targets than energy facilities. You then see that repricing. I think this highlights something that Kevin and I have talked about a lot, Kev Green that is, and I have talked about a lot over the last few weeks. When it comes to crude oil, the fundamental picture has been a downtrend. It's been one of increasing supply and lacking of demand, not just here in the U.S., but internationally, particularly out of China. And the bid has been tied to uncertainty and uneasiness geopolitically.
Yep.
And it continues to be that. We're in the low end of the range. You're taking risk of geopolitics now if you decide to get short crude oil at this point. But at the same time, if you're buying crude oil here, the fundamentals are not in your favor, at least for now. And so I look at this and say more of the same. Geopolitical spikes continue to be opportunities to reduce risk in crude and perhaps even get short outright if you are a believer that the fundamentals are what's ultimately dragging this price lower.
Kevin Green, you watch a lot of crude oil. Your thoughts?
Yeah, I think that the move to the downside here is a little bit overdone compared to what the geopolitical risk premium that we've seen being built into the market, which is around $2.50, give or take. We're down. Yeah, we were down close over $4 earlier when you're looking at crude oil itself. So I would look for a tactical retracement back to the upside here, as you do have a pretty decent support zone sitting at around this $66 to 65 and let's say 25 cents. That's a pretty decent support zone. You already have excessive shorts in this market from a managed money standpoint. You still have the China story. So yes, the geopolitical risk premium is being taken out. But once again, I think it might have been just a little bit overdone. I'm looking for a structured bounce over the next couple of trading sessions.
Yeah, I mean, because we don't, the worst thing you can do right now is assume that it's over. Right? Assume that this is done right here and this move is just going to keep going. There's still geopolitical risk out there in crude oil just because it didn't manifest itself over the weekend doesn't mean it's not there. So I think crude oil is still something very tradable, and the fact that it's already off its lows is significant from crude oil. But I want to wrap this up, because we have three great names to talk about on the rest of the show, and I want to get your guys' thoughts on all those. So let's take our first break of the show and come back with our first trade of the day, which is earnings tomorrow morning before the open. It's PayPal. We're going to talk about that, and we're going to look at other names coming up here. Let's take our first break. Come back in 2 minutes with more Fast Market. See you then, everybody.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market, everyone. Kevin Hinks, joined by Kevin Green and Alex Coffey. My job is so simple today. I'm hanging out with two smart young guys. I wind them up and I turn them loose. Kevin Green, we're looking at PayPal. Today is our first trade. They come out with earnings tomorrow morning before the bell. You know, it's interesting. A one-year chart for PayPal looks pretty impressive. You put up a 3-year weekly chart, it's a different story, Kev. This is a stock beginning its recovery, and I think Venmo's the key. Your thoughts?
Yeah, I completely agree with you. I mean, 3 years, the 3-year chart looks horrible. Maybe it's a basing formation, who knows? But the 1 year, it's actually done a very good job. And Venmo is going to be a very key catalyst for this stock moving forward. And then also their ability to continue to manage expenses and find synergies within the back end to be able to expand their margin potential. It has actually been a really key catalyst for them in the near term. And it's just a name that a lot of enthusiasm when it comes to investors. The cohort of investors out there that really truly believe in this company and the vision that they have moving forward. Let's see if they're going to be able to provide knockout earnings in order to support that. You're kind of looking at some other peers within this space, if it's a Square, or even if you're maybe look at a firm in some respects there have been some positive catalyst from a fundamental standpoint for both of those companies. You want to see that kind of blend together here for PayPal, and let's see if we're going to continue to pop higher and maybe it's able to reclaim some of the losses that we've seen in the past year or 2 years here.
Alex, for as ugly as this stock is, it's got a lot of free cash flow that it has and generates, and it's got earnings per share growth. Mm-hmm. It's not as unhealthy as that 3-year chart shows, and actually the 1-year chart shows that it's starting to recover, actually.
Yeah, I think it's becoming a little bit of a crowded space, so it has that working against it. That said, it's still a growing company. and it's still one that I think when you look at it on a chart basis has started to show signs of life. So you can look at this and say improving technicals perhaps over the last year. The story seems to have bottomed out in terms of the fundamental disappointment. That said, it is on pace for decelerating growth at this point. We know that the market at times isn't really excited when stocks start to decelerate in terms of the growth metrics. One thing that I've noticed throughout this earnings season so far, though, is that the market's been a little bit underappreciative of margin expansion. If that story takes place in a name like PayPal, you could have a situation where it grows a little bit faster in terms of earnings than the market's expecting. That could be a catalyst to the upside. From a trading standpoint, Kev, I know we'll get to eventually, this is one that moves around a fair amount around earnings, so I think that's important to note. And it also may have ripple effects into a name like Block. It could also set the tone a little bit for the consumer as well, although not as clear as I would say an Amazon, a MasterCard, or a Visa will be throughout the week.
Kev, Venmo started out as a gimmick, right? It was a way to reimburse someone for half the pizza. And now it's a serious financial player. It's partnering with Apple Pay, Google Wallet. They do 5% cash back on groceries and gas. This is becoming a serious player in finance, isn't it?
It has been. Now, I'll go back to what Alex did say, though. There's a lot of competition in this space. You're looking at Zelle or maybe some of the other providers there. So this has been a product offering that may have been a little bit slow to start as far as trying to monetize. Maybe they are going to catch a little bit more steam here in the near term when it comes to PayPal. Now, when I'm kind of looking at this company, Alex is right. You're looking at earnings expectations actually kind of coming in at a deceleration on a year-over-year basis. I think this is going to be a guidance story, though. In 2025, you're looking at around 9.4% EPS growth. 2026 expectations are around 12% EPS growth. If you have positive revisions to the upside when it comes to their guidance moving forward, that may give them a little bit more of a premium within the market. I mean, they're still trading at a forward multiple of around 17. That's a lot lower than what we've seen pretty much anything pre-COVID. So they can have a little bit more room to run here. But let's see if their story goes outside of just the growth of Venmo. What are some of the other business units that are going to be able to be monetized and actually show some pretty strong growth here? I think that'll be the winning trade for this company if they're able to explain that.
Alex, you know that this name is getting more popular and more accepted if 100-year-olds like me is using it, not just young kids. Final thoughts and a trade.
Yeah, I think what you're saying is true, but it also has kind of been stagnant when it comes to new user growth. So while maybe the same users are using it as much or a little bit more, they're not getting new active accounts really into their network the way that they were during COVID, where so many things went from, hey, maybe I'll hand you a $20 bill to actually, you know what, let me stay at home and I'll send it to you electronically. So they had a lot of demand pull forward during that time. It was growing really, really fast. It saw the stock price run up. Things kind of normalized, and then, of course, the stock price was under pressure throughout 2022, and it's really never recovered since. So when I look at this from a trading standpoint, though, Kev, you still can't deny the fact that it's down over the last 3 years by 65%, but even over the last 2 years, it's still down by about 20%. Yeah. So you're not, even though you see a stock that's rallied 60% off its lows, it's really hard to say with improving fundamentals that this is a stock that is, at all-time highs and overpriced, because it's just not. And so it doesn't mean it can't go down. It doesn't mean that it can't disappoint. But even though you're looking at 52-week highs, perhaps, the fact that you're looking at year-to-date highs for sure doesn't necessarily mean you're buying the top at the same time. So that chart, you can't get it out of your head.
That's the key. If you think PayPal's gone too far or rallied too much, look at the 3-year chart. Paints a different picture.
When you're not in this situation either, bottom fishing. Yes. Because the stock has put in efforts to make a little bit of a low.
Good point.
Based out a little bit and is starting perhaps a recovery. And so you're getting in, when you look at that chart, it still seems like closer to the bottom than the top if it were to get back to those levels. But what I looked at here was a risk-defined trade, and it looks for an optimistic reaction. What have we seen so far this particular quarter of earnings? Margin expansion and rewarding of stocks that show it. Netflix, big move higher.
Yes.
Tesla, historic move higher. Maybe PayPal's in for a move like that if it can show something similar, especially with, I would say, where the bar is set. it not necessarily being that high of a bar for it to beat. And so when I look at this, I looked at a diagonal spread, Kev, one where you're buying next week's 85 call. That's going to be slightly inside the market maker move or the options kind of pricing of a 1 standard deviation range, and then selling this Friday's a 90 call, which is just slightly above it. And the reason being is if you think it could just get to that particular market maker move spot, Kev, then what would happen would be it would land right in the middle. That's the best case scenario for this.
Kev, here's what I like about this trade. Alex is not making a long-term investment here. It's a relatively short-term trade, a $5 diagonal with about a $2 debit. So it's short-term, it's risk-defined. Kevin Green, your thoughts?
Yeah, I agree with you, and as well as the fact that he's going to be able to roll that short call as well. So if it's going in his favor and it does continue to run, he can roll it to the following week and make a vertical spread out of this. Talked about it being risk defined. That's also another benefit. And then he's leveraging the high IV in order to try to reduce the cost of that longer call that's out there. So I'm right there with you. I like looking at these strategies and looking at potentially rolling them if they go into your favor. You're still going to be capped out to the upside when it comes to those gains, but it gives you a little bit more flexibility in the event that it does run, and maybe you're able to take out a little bit more a little bit more time value by rolling that, let's say on a Friday going into the weekend for next week.
And here's something we're going to talk about a lot in the next couple of weeks: volatility dispersion. The front expiration that Alex is selling about a 96 volatility. The second week, 11 days out, that he's buying about a 68 implied volatility. So that makes that $5 diagonal trade only $2. Even though both options are out of the money, you're still collecting theta because the theta on that front expiration is so strong. So this is a trade that gives you upside. It's short term. The long side is only 11 days. But like I said, it's the earnings event. PayPal coming out with earnings tomorrow morning before the open. All right, I want to thank Alex Coffey for hanging out with us for the first two segments. We're going to take our second break of the show. Kevin Green and I will come back with Landon Swan from Likefolio. We're going to talk about food the rest of the show. Chipotle, McDonald's, those are the names we're focusing on. Take a quick break. Come back with more Fast Market. See you then.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab. Schwab, a modern approach to wealth management.
Market, everyone. Kevin Hinks back here along with Kevin Green, my co-host for today. Now let's bring in the co-founder of LikeFolio.com, Mr. Landon Swan, to the show. He's going to talk some food with us for the rest of the day. Next up on the docket, Landon, we've got Chipotle and McDonald's coming out with earnings tomorrow. Give us your thoughts on this group. Two different stories for two different things, and we all know about food safety and how prevalent that is today. So give us LikeFolio's data, current and future, on really food in general. Landon, welcome to the show.
Sure. Thank you. Great to be here, Kevin. So yeah, I mean, it's lunchtime. Let's talk about it. So when you look at what's going on with, inflation, price hikes, it has really hit consumers hard. And it's affecting everyday consumer decisions. People are, cooking at home more, they're eating out less, and they're actually focused more. They're eating out less, more so with fast food than anything else. That's the data that we see. So there's a bit of there's a difference between a Chipotle and a McDonald's. McDonald's is, fast food, Chipotle is fast casual, and we're actually kind of seeing a break between those. So, Chipotle, Shake Shack, Wingstop, those kind of companies that are a little bit more fast casual are not being affected as badly as a company like McDonald's. And you can see here web visits down on McDonald's, and a lot of these fast food are kind of at the bottom and the fast casual are at the top, right? I mean, there's a clear break what's going on here. And so I think that there's a lot of the fast food companies they're making pushes, McDonald's is reintroducing value meals. Wendy's is marketing its affordability. Everybody's trying to do something. Starbucks is trying to come up with more affordable options. So everybody's trying to crack this code and figure out how to get people back in their stores. But the problem is that these meals that used to be really cheap are now, when you take the whole family of four, I mean, it is really expensive. And so I think that's what's happening. But McDonald's, I'll start with them on kind of the bad news side. They had a great run going. I think that, they got a ton of publicity from Trump. And then, on the heels of that, they had the E. coli breakout. And of course, that's going to send things south. The stock sold off. People are really cautious. You want to make sure, the McDonald's is on top of it, but also like if there's McDonald's here and Wendy's there, and one of them just had an E. coli outbreak, of course you're going to go to the other one, right? Even if you know that McDonald's is probably on top of it, let's just go to the other one. So of course McDonald's is struggling with that. And I will say, when it comes to our data, the spike that we had from Trump and then E. coli is sending the happiness all over the place with McDonald's. So, it is insane. There's a few times in LikeFolio history where our data kind of gets broken, and that combo is one that's kind of breaking the McDonald's data. So it is all over the place. Now, Chipotle is actually doing a lot better. They've got this brisket offering that's new, that's driving people to the app. The monthly active users for their app is up almost 50% on a year-over-year basis, which is obviously huge. And I think that everybody's kind of getting excited about that. So Chipotle hitting the right spot right now, and the stock isn't going. It's up, but it's not out of control up. So I don't think that the expectations are way too high. But again, the brisket is really driving people. You can see that last bar on the chart there, out of sync with the rest of the chart, and it's out of sync to the good side, to the upside. So I'm very happy to see that. The others that we kind of talked about, Wingstop is also doing well. Shake Shack is kind of holding its own. But the big story, I think, is the contrast between what we're seeing in McDonald's weakness and Chipotle's strength going into this week of earnings. And a lot of it has to do with that dividing line between fast food and fast casual. But it's also down to specific execution and, failures, I guess, when it comes to McDonald's and food safety versus success at Chipotle with their new menu offering.
So Landon, it does appear, in my opinion, that Chipotle was kind of had the first mover advantage when it came to the digitization and leveraging the apps in order to try to drive in traffic into their stores here. But I'm starting to see Wingstop pop up on a lot of analyst coverage as far as positive coverage from them. I see your data. Do you think that there could be some market share give up by Chipotle because of Wingstop's sudden rise when it comes to popularity?
It could be. I think you could also just kind of see it again as that divergence between fast casual and fast food. I think that, obviously, Chipotle wants to dominate the market. They're not a direct competitor, but if you're hungry, you're going to one or the other. So they don't, even though they don't serve the same type of food, they are a competitor. But you can see here, Wingstop is at the top of our list. They actually have a better earnings score this week than Chipotle, even though they're both pretty strong. Wingstop is definitely the one that we're kind of have an eye on. It was one of our top 4 picks of the week, I think, for our earnings system. So we do like it for sure. And we, yes, they could be taking away market share, but I think it also just kind of proves the point that when people if they're going out to eat, because everything is so much more expensive, they want to have a better experience than the drive-through or sitting down, ordering in a kiosk and then sitting down at a fast food place. So if you're going to spend the money nowadays to go out and eat, which is no longer cheap, you might as well go to like a fast casual type place, which is why I think both Chipotle, Wingstop, and of course Shake Shack are kind of hanging in there. But to your point, yes, Wingstop is doing very well.
Landon, when I look at a name like Chipotle, and that's what we're going to trade at the end of this segment, there was a little bit of a Brian Niccol hangover when he decided to go to Starbucks, but what you're discounting there is the rest of the management team that is actually pretty solid. And their growth strategy of going around 3,000, 3,500 restaurants to 7,000 is still intact. How about this stat? In the second quarter, they opened 52 new Chipotles, 46 had Chipotlanes, so the drive-through. So that's clearly their strategy going forward. And this is a company that, sure, will miss Brian Niccol, but they seem to be on a pretty good path. And by the way, the brisket, life-changing. The brisket is life-changing. Landon, your thoughts?
I haven't had it yet.
It's
I've heard
good
things. And just looking at our data, I'm like, I got to try this because the spike is incredible on those monthly active users on the app, up 50% year over year. That bar is so out of place, and it's basically due to this one menu item. Obviously, that's going to be highlighted on the earnings call. I'm sure they're going to have some increases in price because that's a more expensive protein. But still, I agree. I think that obviously you want to have your leaders stay with you, but if he did a good job, he trained his team to follow this path, and I don't think that they're deviating from the plan that he laid out. And yeah, just like you're talking about, basically doubling the number of stores. Yeah, I'm in on that, right? I want to be an investor at a company that doubles the number of stores that are profitable. So yeah, absolutely. I'm bullish on Chipotle long term. I think that the stock is, it's kind of been ho-hum lately. It's drifting upward, but I don't think that investors are crazy bullish on it. And I think that there is a little bit of a room for a pleasant surprise on earnings today. So we've got our score at plus 26 on the scale, from negative 100 being bearish and positive 100 being super bullish, plus 26, which is enough to place a bullish trade on them. It's not, we're not betting the farm, but we do think that there's a greater than 50% chance that they go up on earnings based on all the data that we are seeing.
Great discussion, great data as always from Lifefolio, Landon. We appreciate you coming on all the time. Thanks for spending a little time with us today, Landon.
Thank you, Kevin. Enjoy your lunch, and I'm going to see what you got for this trade. I'm excited.
All right, Kev, you have the trade for today, the paper money trade. What did you bring for us today on Chipotle?
Yeah, looking at a little bit more of a bullish move, as you kind of talked about, maybe a little bit of an overreaction because of a leadership change. I mean, their progress so far should be more of a set it and forget it for this executive team, and that's what I'm actually expecting when it comes to earnings. So I'm looking at a bull call spread, looking at buying the $62 call, selling the $66 call. This is for November 1st, so expiring this Friday. Doing this for a debit of $1.30. Max loss is going to be the debit paid, $130. Max gain would be $270. So you're looking at around a 2-to-1 risk-reward ratio for this trade. also risk defined with a break-even point of $63.30. So Kev, obviously this is going to be a strategy in order to capitalize on an upward move for this stock. But once again, I feel like it got beaten down and not in the right way. And so once again, trying to see if they're going to be able to shock the street to the upside when it comes to their earnings announcement.
We'll go over this trade and then we'll discuss it a little further. A long call vertical spread in this week. So it's only a 5-day spread. It expires November 1st. Paying about $1.30 for a $4 call vertical. Buying the 62 call, selling the 66. That means the break even on this trade, 63.30 on this trade, which is, you know, both these trades are out of the money calls. So that is something you need to move for this trade to be profitable. So this is a bullish perspective here in Chipotle. If you are not bullish on Chipotle, this is not the trade for you. It's paying a little bit of theta because both options are out of the money, but this is one, unlike the short vertical, this is one that pays you exponentially if you're right and it moved towards that short strike at $66. So Kev, your final thoughts here. This is a trade that you need some movement, but if you get it, it pays you off multiple.
Yep, agreed. And this is, a strategy that's able to also offset that long call position. So rather than just buying something that's at the money, you're leveraging an out of the money call in order to reduce some of that theta and that IV crush that actually can happen post this report. But once again, this stock can actually have really dramatic reactions, either to the upside or downside. And over the last couple of quarters, last couple of years, they usually have had really positive upside reactions. So trying to go with that previous trend, leveraging this in order to try to capitalize on it. And I like the risk reward ratio compared to maybe just going with an outright long call.
The risk on this trade is what you pay, is the debit paid. So we had it up there 130. It's trading about $1.15 right now, but the debit you pay is the risk on this trade. You're looking for a move up towards $66. If it does, you have to worry about, remember, the most important thing to worry about here is if it moves in between 62 and 66, that the 62 calls could be an exercise or assignment, and the 66 calls could finish out of the money. So make sure you understand that you do have to defend this trade if it moves in between the strikes. If it goes over 66, that's a different story. And at any time, you can, if the market's open, liquidity provided, you can put in a limit order to sell this out. All right, Kev, let's take our final break of the show. Come back with the market update. Come back with George Tillis talking about our final name of the day, and that is McDonald's. More food. Take our final break. Come back with more Fast Market. See you then, everybody.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Fast Market, everyone. Kevin Hinks, Kevin Green, back here for our final segment. Before I bring in George Tillis, let's do a quick market update as we head towards 12 noon in Chicago, 1 o'clock Eastern time. The S&P 500 up 0.4%. 23.5 points to 58.31. The Dow Jones Industrial Average up 0.7%, 300 points to 42,413. The NASDAQ 100 up 0.25%, 53.5 points to 20,405. And the Russell 2000 extending its gains now, up 1.58%. 35 points, almost 36 points to 2243.80. All right, now let's bring back in Kevin Green. Let's discuss these markets, Kev. We're getting to midday here in this trade. We've got big data and big earnings coming up on the horizon. Give us your thoughts as we head to the noon hour here in Chicago.
Yeah, so Kev, we're going to have a 5-year Treasury auction in about 15 minutes, so keep your eye out on that. We had a 2-year auction earlier in the session, and it was actually a lot weaker than the street's expectations, which is one of the reasons why we kind of saw a little bit of a pullback. Now we're just battling out, trying to maintain that 58.30 level for the S&P 500. But if we do get a weak 5-year auction, Kev, that could create a little bit more selling pressure as yields kind of move up for the wrong reasons. But overall, we've been able to hold up. When you're looking at the breadth of the market, it's looking pretty good. But those mega cap names really got to try to either hold the gains that we're seeing so far or try to push a little bit higher in order to give us enough confidence to try to break through this range that we've been in for the last 5 trading sessions. But overall, it's been decent.
Crude oil down 5.5%, giving these markets a boost. They're green across the board. All right, Kev. Now let's bring in from Salt Lake City, Utah, Mr. George Tillis to the show. He's going to talk about our final trade of the day, and that is McDonald's. McDonald's up today, George, on some good news that it's not the beef, so they think they're going to release the quarter pounder back out into the wild coming up in the next days. Give us your thoughts on McDonald's. They have earnings before the open Tuesday. Your thoughts?
Yeah, so obviously, it's well known what's going on with the E. coli outbreak. It looks like it wasn't something that was at fault of McDonald's. So, you see this as potentially an opportunity as the stock is down about 8% or so off the highs. And in fact, it's been trending very well off of the 200-week moving average going all the way back to July. Just because the stock is down 8%, there are some levels, at least from a technical standpoint, that it's holding. Did close below the 50-day moving average, so we'll see at least one day, but we'll see if there's 2 consecutive closes because that's meaningful. But nonetheless, there's a lot of talk that this is essentially a challenge that McDonald's will obviously get over time. If you look at some of the earnings estimates for the name, the stock or the company is expected to earn about $3.20 a share. Now that's down, that's slightly higher, forgive me, from last year by 1 penny, so slightly less than 1% higher versus the $3.19 for the same quarter last year. Then sales at $6.82 billion are actually expected to be higher by 6.4% compared to $6.41 billion for the same quarter last year. Now, the reason earnings are not expected to grow very much for the quarter, I'm sure there's going to be some impact because of this outbreak that occurred. There's going to be some litigation and overhang. But nonetheless, I think that the stock is probably going to rebound with the results in mind. The reason the stock is, the earnings per share aren't growing very much is that the company is expending quite a bit of money for automation because they're trying to, head off some of the labor costs, which are starting to put pressure on the stock. But nonetheless, earnings estimates, at least on a forward basis, are expected to continue to rise from about 6% for the full year, including the quarter they're about to report, percent to about 12%. And that's about 500 basis points or 5% higher than their 5-year average. And even revenue, if you look at it over the last year, about 6.5%. The revenues are actually expected to decline fractionally to 6%, but the earnings growth are estimated to continue to grow going forward. So, I'm looking at the forward aspects of the financials slightly down, expectations. That's more conservative, but earnings are expected to grow. And overall, the stock is not trading at a very lofty forward valuation. 23 times next year's earnings, where historically it's around 27. So one would say that maybe it's fairly valued, maybe perhaps undervalued. plus considering at the very least it'll make up maybe half of that loss that incurred because of the E. coli outbreak.
So, George, it seems like there's a little bit of a battle between the franchisee owners out there as well as the executive team. The value menu has also been a very key driver for sales over the last couple of quarters here, and it does appear that they're going to extend that out. How do you think the market's going to react if the executives for McDonald's decides to kind of keep that value menu in place, knowing that it's going to eat into some of their margins like we saw this time last year?
Well, I think it already has eaten in their margins, and I think the other thing is expenditures for automation have eroded into margins. I think if they maintain that value menu, at least going forward, they'll increase volume of sales. But at the same time, prices that are remaining firm, in other words, if they discount or remove some of those value elements, prices will essentially be moving to the upside versus some of the volume constraints that some consumers will face. But I look at this company as relatively recession resistant. I mean, at the end of the day, people need to eat. It's certainly not the value it once was for those who go to their restaurants and eat quite often. But nonetheless, I think the profitability profile for the business looking forward is quite good, considering, again, some of the litigation and overhang with the E. coli outbreak. So I'm sure they'll give us some guidance in that regard. But, like I said, if you just look at the stock going back to July, that was a tremendous opportunity, both from a price value, but also, like I said, from a technical standpoint, bouncing right off the 200-week moving average. And again, it is a moving average that I actually look at for value names, companies like McDonald's that are facing some maybe seasonal or cyclical challenges. But a lot of times, a 200-week moving average is a great buy point.
George, one last thing for you. Food safety concerns, there's a track record, right? We have a history in this country of food safety concerns, what they do to the stock, what they do to the company. McDonald's traded as low as $282, so it's $14 and change off its lows already. Are we getting a better roadmap to how to navigate these as investors? Because it seems like like the timetable for getting in this, getting through it, getting over it is a little shorter here.
Yeah, that's the thing. I'm not, discounting the severity of the outbreak. Obviously, it's hurt a lot of folks, but it really comes down to the origination of the outbreak. And it's not a McDonald's issue. It's a supplier issue. And it's not just the McDonald's that was affected. The recall affected multiple, fast food chains out there, which pulled their products. So, I mean, if you look at the stock, even though, like you said, it's up about $14 off the lows, it's still down, I would say around $22 off the highs. So it made a significant move to the downside. It's down about 8% still, but it was over 10% considering the initial dip in the pre-market last week. But it seems to be recovering. So, right now, I'm going to say that the trend is still intact. It's still holding the 50-day moving average. But a lot of times, irrespective of the terrible outcome of this outbreak, these can provide great opportunities because they don't last. These outbreaks, they seem to have well contained this quite quickly. Sure. And there's going to be, of course, some litigation damages, which they'll allude to in their call. But nonetheless, it may be an opportunistic buy considering the value of the stock seems to be undervalued considering its 5-year average.
George Tillis, great discussion as always. Thanks for coming on the show. We will see you soon, sir. All right, Kev, let's get to the paper money trade now because, remember, they have earnings coming out tomorrow morning before the open. The expected move, we'll round it to $10. And so the trade that I looked at here in paper money is to take advantage of the higher level of implied volatility, go to about the 68% probability of finishing out of the money. That's the 290 put in this week. Sell the 290 put, buy the 280 put, so a 10-point short put vertical. It's about 69% probability that 290 put will finish out of the money. The premium we have on it is about $1.60 credit. Probably trading about $1.75 credit now, Kev. This is risk defined. It's collecting theta. It's high probability, Kev. Your thoughts? We got about 2 minutes.
Okay. Yeah, I'm right there with you, especially when you have not only earnings vol, but you also have this event risk vol that's within this market. So if you are under the impression that that's going to abate over the next couple of trading sessions, this is the trade that's going to be able to try to capitalize on that. And then once again, kind of risk defined in nature. So I think you're on the right track there, Kev. It seems like you're a little bit more optimistic when it comes to this company, and the supply chains have definitely changed since we've seen the Chipotle issue a couple of years ago here. And this gives you some upside potential if this is going to be a nothing burger at the end of the day.
I think there's a key a path for how you handle this. Number one, you're very transparent, you're very honest, right, all the time, and then you go over and above for the customers. As long as you do that, investors gain confidence quicker. You get to the bottom of it, you're transparent and honest, and then you take care of the people involved. I think if you do that, this stock, the overall feeling about McDonald's will recover. So a short put vertical, 69% chance of finishing out of the money. Selling the 290 put, buying the 280 put. We have it up there for about $1.60. It's trading about $1.75 now. The risk on the trade is the width of the strikes, in this case $10, a $1,000 margin minus the credit that you take in. So if you do 160, it's $840 is your risk on this trade. If you sell it for a little more, that risk goes down. But the outsized risk on a trade like this is because you're selling an out of the money put vertical, which means if nothing happens, you're profitable on this trade. It could even sell off and you could be profitable on this trade. All right, that's our show for today. I want to thank Kevin Green for spending the hour with us. Always a pleasure to see you, Kev. That's our show for today. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on the SchwabNetwork.com. Stick around here. Alex Coffey, Jenny Horn coming up next with Next Gen Investing. Have a great day, everybody.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's
nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, some pretty nice green arrows across the board today with strength in a lot of our actually tech, although it's a bit of a mixed picture because Microsoft is lower, Tesla's lower, Nvidia, the stalwart of our markets as we joke, is also down 0.7%. But Apple, Amazon, Alphabet, Meta, all higher on the session. And a lot of these companies have earnings this week. 5 of the 7 of the Mag 7, of course.
Yeah, two things can be true at once, right? We have a lot of green on the screen and we're simultaneously like on session lows. So it goes to show that it was a really strong open. It was a market that was plagued with a little bit of uncertainty into the close on Friday surrounding geopolitics. After, not necessarily a resolution, but fears dissipating, tensions coming down a little bit over the weekend. You saw a pretty sizable jump on the Sunday night open for futures, and that led to a pretty nice open for U.S. equity markets, which actually saw the S&P 500 open, let's call it 5 to 7 points higher than where we're currently at. So a little bit of weakness as the days rolled on, but hey, can't be upset when we're up 20 points in the S&Ps, 1/3%. Russell way out in front, 1.65%, playing a little bit of catch up. And this in the teeth of a yields move higher once again. So none of the playbooks are necessarily working here today in terms of how the markets relate to one another. I think that can kind of make sense too, Jenny. We have so much mega cap tech on the horizon. We have so much macro news to explore and unpack throughout the week. I don't think that it's unusual to see a relatively quiet, choppy, kind of drifting market here. Who wants to take a bunch of risk with all those things on the calendar? And likewise, it's a place where many may think about taking some risk off ahead of that unless they have conviction one way or another.
That is very true. And I will say that on top of a very, very jam-packed full week of earnings, we also, of course, have the election in about a week. So we have that volatility to also parse through, as well as we have jobs numbers out on Friday. So this week is busy. We joked last week was themeless, but that is not the case for this week. So as always on the show, we'll kick things off with our upvote and downvote segment. We'll be charting and trading those upvoted names. We're looking at all earnings previews today, as there are still a ton outside of even the mega cap tech names. We'll also be diving into SoFi ahead of their earnings due out tomorrow morning. This name has risen, so substantially on the year, about now 13.5%, but also is now still up about 64% on a 12-month basis. And we'll be diving into Taiwan Semi, as their founder did warn of some overall demand concerns, which is obviously not what you want to hear from one of the biggest names in the AI story. And we'll close things out with Ford, which has earnings this afternoon. Will be interesting after GM's really stellar third quarter report we had just last week.
Yeah, SoFi, pretty fascinating looking chart. We know that it's one that's very, very popular amongst kind of the next gen of investors. It's a lower price name that trades with some volatility, in this financial services world, but a nice looking little breakout underway in SoFi. So the bulls have been patient there, perhaps finally being rewarded with some upside in that stock. So that'll be fun to talk that. Discuss sort of the old generation that is Ford with George later on. But let's do upvote, downvote, not endorsements, not recommendations. The theme is earnings, as you mentioned, Jenny, and that is, of course, going to reign true here within our upvote segment. All of these names either report after the close today or tomorrow morning. So true earnings trades perhaps in store for any of them for those interested. First one on our list here, VFC. And you can see a chart that has kind of got a lot of people scratching their heads, I think, because it looked like it was going to break out and then it took a U-turn back into that pattern.
I know the winning trade of retail this year has been all things shoes, but unfortunately for this company, that has not been the case, as they just do not operate in these brands that have seen stellar growth, like On, for example. Deckers was another one with a really banner report last week. So we're expecting a top and bottom line decrease when we see their second quarter results due out today after the closing bell. Last quarter, they delivered an earnings surprise of 6%. So we are, maybe we could see some improvement because the bar has been set, I think, relatively low. We are expecting the results to be marred by a tough operating environment, including inflationary pressures they continue to mention on their earnings calls that have weighed on a lot of their profit. So they've been witnessing some soft performance across the regions and various channels for a while now. That's not really a new narrative. Their wholesale business in the U.S. has been witnessing challenges as some of its major partners have been taking a more cautious approach now going forward. This has weighed on their segment's results. They've also been battling weakness in brands that have just been falling in consumer interest. Vans is one, North Face is another, and these brands have been experiencing a struggle to connect with their core customer bases. For North Face, that's really stemmed from shifting preferences and increased competition in the outdoor apparel market. Vans, though, I was on their website because for fun, because I'm a Vans girl, so I'm hurt to hear that this brand is not cool anymore, apparently. And I will say their website, like, nothing's really changed with Vans, which I like. I mean, I buy the same shoe like every 6 months, but I'm probably the minority in that way.
Well, here's the thing. You used to say, and you still say, I think, it's always earnings season if you're a believer. Vans are always cool if you're a believer. That's my theory on this. One thing that I thought was interesting, stock on its last earnings event was a nice performer. It jumped about 7%. It actually broke an 8-quarter stretch of negative responses to quarterly earnings. So only 2 of the last 10 have been higher, and those bookend the last 10, going all the way back to May of 22, and then of course this last one that we just had in August of 24. It does move. And there are, of course, examples where it didn't move a lot, but you have a 13, almost 14% decline. You have a near 10% decline. Then last quarter looks like a 7% jump. So a lot of volatility perhaps in store if they do either surprise the street one way or the other. Next one on the list, though, DHI. This is DR Horton. Now we're looking at a totally different industry. Talk to me about what we're expecting here.
An industry that I think should be faring better from lowered interest rates, although I will say that they've done quite well despite being our only name actually lower slightly here on the session. Last quarter, we saw revenue drop about 3% year over year, a reversal from the 9% increase we saw in the same period a year ago. Adjusted earnings, though, came in around expected to come around $4.17, $4.20 a share, we'll call it. But the majority of analysts have confirmed their estimates over the last month or so. So far, we've seen the home building segment have a fairly steady pace going into its earnings. We've seen, across the industry, share prices remain down about 1% for the month. DR Horton is down about 6% over that same time frame heading into this report. But again, there's been this sentiment from a lot of these home building CEOs that have said there's this deferral period they were seeing over the summer where everyone was waiting for lowered interest rates to purchase these large ticket homes, and also supply does remain relatively still constrained. Selling prices have moderated a bit. We've heard that from pretty much every inflationary read, but still a difficult home buying right now environment to work through. Although I will say DR Horton is one of the largest, so I do think it tends to be one of the most important, at least in my eyes.
Yeah, it's one that's had a lot of beats in recent history. When you look at that over the last few quarters, I'm only seeing 2 misses on earnings going all the way back to 2019. So a lot of positivity coming out of DR Horton. Big move last time around too, a 10% jump. Investors hoping that they can build on those successes quarter over quarter. One of the areas that I think I've been most surprised by the comeback in has been the cruise line space. RCL is the next one here on our list. Jenny, the beats here are massive when they happen. It had a 34% beat on EPS that corresponded with a near 55% rally. It had a 67% beat back in May of 23 that corresponded with like a 70% rally. And those are not even the biggest ones. So I'm not going to go down every single one, but there's been a lot of positivity. Haven't missed since May of 2022 when it comes to earnings. And they've also had positive guidance every single time alongside that too.
And I think it's encouraging. We've heard nothing but optimism from the airlines. I know we saw Southwest and American trade slightly lower, but all these airlines have basically said they expect still solid demand into the back half of this year as far as travel is concerned, which would, I think, then bode well for also a company that operates in the tourism space. This name's up 56.5% on the year. Like you said, strong earnings have set the high bar for this company, as we've seen overall industry growth potential mentioned by so many of the analysts that cover this name. Of particular note, their adjusted EBITDA is projected to be 40% higher than it was in 2023 due to this overwhelming demand for cruises as well as additional cost savings measures. This demand is being driven by the fact that younger people are now more interested in cruises as opposed to just the baby boomers. So that means that in addition to the post-pandemic recovery, there's now this increasing customer base then, which leads many to believe that the industry peak could still be a ways off. So in addition, I was reading this report out of JP Morgan's Industry Outlook that said cruises are sometimes cheaper than land-based vacations, which is definitely then even a positive sign in terms of economic uncertainty. I thought that was very interesting. I have never been on a cruise myself. I know that you're also not a cruise guy, and Kevin Hanks is like our cruise expert, but maybe this is becoming more favorable amongst that younger demographic.
Yeah, I can't speak for that for sure, but what I think that always has been the appeal, especially for families, is the affordability aspect. The fact that it takes the thinking out of vacation a little bit. A lot of the things are kind of planned for you. You're given options for that. And you know, in hindsight, obviously the pandemic, I think, really dampened this from an operational standpoint. But you thought maybe kind of the PR around some of those boats not being able to dock and get the people off would have hurt it. But you also look back even pre-pandemic, there'd be, YouTube videos or wherever you watch videos of like the weather getting a little bit bad and things sliding around and look kind of scary at times, but people still go on cruises. So I'm convinced now that if you're a cruise goer, there's nothing stopping you from going on that cruise if you can afford it. And so, hindsight 2020, of course, but this stock has gone 10x from its lows on COVID, and it's been an impressive comeback.
It has, and it's been resilient, gosh, in spite of some of the trends we talk about with consumers pulling back their spending. That has not been the case for cruises. I agree. I think that those that love cruises will always love cruises, despite some of the maybe frightening PR surrounding it. Our last name today, though, is another name that has been strong this year. That's Crocs, which is up almost 49% on the year. It's pulled back about 16% from its 52-week highs. But as we go into this report, I was reading the funniest note that basically highlighted from Deckers that some of these shoes that are considered ugly are still winning as far as consumer interest. Maybe Vans needs to boost their ugly shoe offerings, but they have been seeing their business continue to strengthen in their sandals and personalization efforts. Their Jibbitz business has also been doing well for quite some time, as well as they've been benefiting from the solid direct-to-consumer channel and partnerships boosting their performance. Their direct-to-consumer revenues pegged at $550 million. That would be up 4% year over year, with solid performance across Crocs and Hey Dude brand, which have effectively then regone some pricing measures to aid their performance. So last quarter, we saw projecting their Crocs brand third quarter revenues to rise between 3 and 5%. However, costs associated to that Hey Dude acquisition do still remain, I think, a headwind going into this print.
Yeah, this is another one of the apparel space, footwear space names. So these are some fascinating numbers. Average beat is by 40-some%, almost 45% over the earnings expectation by the street. So it's one of those names where the expectation is for strong numbers going in. It's only missed earnings going back to the beginning of 2017 twice in that entire period. But that doesn't necessarily mean that you're going to see the stock higher. It's a little bit more mixed 50-50 in terms of price reaction. And in the last 6, you've actually had 4 reactions to the downside, despite really, really nice beats and really, really nice guidance accompanying all of the last 6. So something to think about going into this report if you're thinking about making an example trade in one.
I know earnings have not been favorable to this company, so we'll actually be looking more at that chart, which could speak to more of some of these weaknesses we've seen on the back of earnings. We'll also be diving into VF Corp, of course, our shoe trade, as well as some example trades in both of those names. Stick around. Next Gen Investing. We'll be right back.
the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's time now to dive into our upvoted names for our Chart Master segment. Joining me, of course, is our Chart Master, Rick Ducat. So we're looking at 2 names in the retail space. We'll start off with VF Corp, which was actually quite a strong name. And we saw this breakdown, Rick. So what are we expecting into this earnings report?
Yeah, a bit of a breakdown indeed. That's a good word for it here, because you can see that we had a pretty nice rally here for quite a while here. You could have drawn 2 white trend lines here, one going across the lows, duplicate it, put it across the highs, matched up pretty decently here. That encompassed most of the price action, with some notable upside excursions, kind of tested those boundaries several times here. And the big one was right here that took us into our yearly highs, 52-week highs, 2140. Previously, the level was 2069, but it was not really to be. Very quickly fell back downward, closed lower, and then broke through our steeper blue trend line here, and then finally really kind of the other shoe fell. Now we're below our channel, we're below all 3 of our moving averages. We did test the previous low area near here, this green line, 1652, and we did hold on, so that's at least somewhat encouraging here, but there's a lot of work to do still. And today actually looks like we're kind of forming a bullish engulfing candle. Yesterday was a doji, or not yesterday, Friday, excuse me, was a doji where we opened and closed right near the same level here. Today's big green candle completely swallowing up the previous trading session's small candle there. So look for bullish follow through. If we do get that, that would be the confirmation for that type of candle pattern.
Okay, and so recently, obviously, we've fallen below the previous range we were trending upwards in. So what is momentum then indicating to you here for, obviously, this report?
Unsurprisingly, momentum has taken a hit. It's kind of, obvious when something like this happens that momentum's going to suffer. The question is, how much did it suffer? We fell out of the overbought area. That was kind of the first bad sign. Fell below the 50 midline, but have so far managed to stay out of the oversold area. So that's at least a good thing. Across below that threshold of 30 would be a further bearish sign here. So be on the lookout, especially when you are near an important support area or resistance area, if it was the opposite situation here. But when you're near a support area and RSI is getting pretty low, look for price to break lower and RSI to break below that oversold threshold to kind of give you some bearish confirmation. That would be kind of more of a bearish confirmation kind of setup we would be seeing if that were to happen.
Okay, yeah, and I will say that this name, at least there's a lowered bar into this report, but as far as now some levels we're watching, hopefully can see that reversal of the uptrend, but what are we seeing for support and resistance?
Yeah, and earnings can really change things too. So that's, it could throw everyone for a loop. That's why it's a good idea to stay risk defined if you're planning any types of trades heading into this earnings announcement here. But I'll start with the downside. That seems a little easier. We've got kind of a double bottom right here at our green line, this low point that we touched a couple times around that area, 1652. Volume profile point of control, our thick red line, our area of heaviest trading, an important potential pivot point near 1616. Then finally all the way down here, once again another double bottom, a low point we saw after another gap up near 1477. That would be quite a fall. I'm just looking, for possible areas of interest. I'm not saying it's going to get there. But if we were to look to the upside, we've got our moving averages here. Purple 252 is the first stop near 1747. Then our old broken trend line lines up with the orange 63-day EMA near 1794. Finally, the high point we had after our gap down lines up with our yellow 21-day EMA near 1850 or so.
Okay, so a lot to look at here, especially considering the market is pricing in a almost $2 move in either direction. Obviously, we've already risen about 3% today, but expecting a pretty big move for a stock that trades at $17. So with all that considered, walk us through what you think about trading this name.
Yeah, so rather than trying to pick a direction with this one, we looked at a more neutral strategy, but one that looks for volatility. So different than maybe an iron condor that doesn't look for volatility. This one wants a move, and what we looked at was a double calendar. So someone who has a little bit more directional conviction could look at just one side of it, but what we looked at here was both the put calendar and the call calendar, creating the double calendar spread strategy. We also gave ourselves a little bit more time with this example trade. Selling November monthly options, buying December monthly options creates, rather than just a mountain peak, almost like a little mountain range. You got both a point to the downside near 15, which is our put strike, and a point to the upside, which is the 20 strike that can be a best case zone for this particular strategy. Now, the whole package is done for a debit. It can be done as a four-legged trade. If it's done for a 50-cent debit, which it was trading at earlier on this morning, that would be $50 in total risk. Now, what do you not want to happen with this one? Either absolutely nothing, where the stock kind of stays at 17.5, but even more so, you don't want to see this stock plunge or go up dramatically, where it would overshoot either 15 or 20, but there is a lot of time till that December 20th expiration, so probably not one that is resolved just around this earnings event.
Yeah, I would say that this one has more of a long-term story of improvement, obviously, because it's been a pretty negative story as far as the narrative surrounding its earnings. But our next name today here is Crocs, which has been more of an improvement story as well. As Alex had previously mentioned, it's seen some pretty substantial moves to the downside after the back of its earnings. So walk us through how you think about looking at this chart, Rick.
Yeah, triangular shape was the way things were looking for a while. We had kind of a nice rally to the upside here, topping out near 165.32. From that point, though, we can connect these subsequent highs with our blue downward sloping trend line here. You also could have made an upward sloping trend line going across the lows, converging toward each other, and we did get a downside breakout here. So we fell below our moving averages, the confluence of our yellow 21-day and orange 63-day exponential moving averages, which were right on top of each other for much of this area that we've been in here. That suggests lack of a clear trend direction here. When you see that happening, it usually speaks to, kind of choppy prices or kind of sideways prices, or, not enough to eke out a directional bias here. Now we're in kind of a rather confusing situation, because in addition to our triangular pattern, I also had kind of a channel, a downward sloping channel in white, a rather short-term, rather narrow channel here. And for that measure, we're still within the boundaries of that, but we've managed to fight our way back above the lower blue line that was in our triangle pattern here. So we're kind of back where we were before somehow, and we have retaken our moving averages. So kind of a weirdly bullish development here as we head into this earnings announcement here once again here. So we'll have to look more at this one to figure it out.
Okay, so yeah, lacking some direction here, but as far as momentum, is that giving you any indication sort of where the move is headed?
I wish I could say I had a clear answer here, but kind of the confusion sort of continues as we look at this area right here. On one hand, you can see a green trend line going up across the lows that was broken and recaptured, just like our trend line here with price. On the other hand, we had our red trend line, which has been invalidated here. So we're above our green trend line, our red downward trend line has been broken, and we're moving above the 50 midline here. However, we still haven't taken out price resistance here. So it's kind of, even though the momentum setup is improving here, the price hasn't really followed suit just yet here. We're still kind of stuck at this boundary. Even if we were to break above that area, we've still got the old highs right here near 144. So kind of still a bit of work to do before we could kind of cleanly put this one in the bullish camp.
Okay, yeah, and I think that's safe to say, especially considering the more recent downtrend we've seen in price. So now when we watch some levels here into earnings, we expect those tomorrow before the market opens. What are we watching?
Yeah, if we were to move downward, if this kind of move we've been seeing today falters, falls apart here. The recent lows are pretty close to the purple 250 2-day EMA. Those come in at 128.20 for the EMA, and the lows were 129.69. So roughly 128 to 130 would be a supportive zone to keep an eye on here. The next set of lows right here, 123.20, roughly lines up with a volume spike right around there. You can see another volume node right here as well. We're working our way through it, but this high point that I mentioned earlier, 144.23, is the first stopping point. And then look above this pink line, frequent stopping point, frequent congestion point, repeatedly kind of bouncing around that area. Around like 146, 147 would be another key area to overcome for this one.
Okay, yeah, and hopefully seeing some favorable trends because shoes have been the winner of retail as of late. So now, when we go into this earnings print here, Alex, walk us through a more bullish leaning example trade, just of course, considering this has been a bit more of a strong player in shoes this year than VF Corp, for example.
One that has a history of showing strong numbers, but it does, of course, come down to how the market interprets those numbers. What we looked at is a bullish strategy, as Jenny said, for this example trade. And it's in that time spread family, but it's a call diagonal spread. So a little bit of an attitude relative to what we looked at in VFC. In this case, what we looked at doing was a lot shorter term as well. Buying next week's 150 call, selling this Friday's 152.5. Doing so allows us to create a risk profile here that does not theoretically take any upside risk. So only spending $1.50 on a $2.50 wide diagonal spread. As a result, it does eliminate that theoretical upside risk. You don't have to be quite as precise. The diagonal, as structured, allows for a little bit greater margin of error, but still there's a best case scenario at the apex of that risk profile, and that of course is the short strike of 152.5. Looking for a jump in the share price here, Jenny, around earnings is a potential catalyst.
Yeah, and I will say I hope that we see some more favorable price activity after its earnings, as we've not seen that as of late. But hey, even on the session right now, seeing some improvement as we're now at 4.5% real time, with markets firming up here overall across the four major averages. So we'll leave it there for our Crocs conversation as well as our shoe conversation. But coming up next, we'll be previewing another name ahead of their earnings. That is SoFi, a name that's also perhaps stands for some improvement and favorable trends here as we go into their earnings due out tomorrow morning.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time for FOMO. So we are looking at another names with earnings out tomorrow morning. That is SoFi, which has been, I would say, an interesting one, just given its extra volatility we see without even earnings, really, frankly. So here joining us to discuss more on SoFi, what the street is expecting, what we can look out for here, is Caroline Wood, Senior Markets Correspondent for the network. So Caroline, walk us through this SoFi story, because it's volatile. And this one has, I will say, like a camp of enthusiasts that are very strong believers in all things SoFi.
Hey there, Jenny. Yes, and SoFi has been on a tear this month. If you take a look at the monthly chart, shares are up more than 40% in October, up another 2.5% today, ahead of earnings tomorrow morning. As you said, it seems like a key catalyst for shares has really been lending gaining traction. Earlier this month, SoFi announced this $2 billion loan platform agreement for personal loans in partnership with Fortress Investment Group. The agreement will basically expand SoFi's capabilities in the loan platform business, and it basically refers pre-qualified borrowers to loan origination partners and then originates loans on behalf of third parties. And that sent shares skyrocketing higher earlier this month, and they've only added to those gains. SoFi CEO Anthony Noto said SoFi's loan platform business is an important part of our strategy to serve the financial needs of more members and diversify towards less capital intensive and more fee-based sources of revenue. So I think it's important to note that SoFi really operates in three key segments. Lending, of course, which includes student, personal, home loans, and then there's the financial services and the technology platform. Lending was central to the business, but financial services and tech have really been picking up steam and growing. So when they last reported, a lot of the focus was around growth in financial services and tech, saying in Q2, the financial services and tech platform now make up a record of 45% of SoFi's adjusted net revenue, up from 38% a year ago and then 32% 2 years ago. And then Q2 revenue was driven by 46% combined growth in financial services and tech platform segments, as opposed to 5% growth in lending. So I think the fact that lending appears to be picking up steam and growing seems to be making investors enthusiastic. And I think that Lending Club's huge beat in terms of earnings and revenue only added to SoFi's gains. They gained about like 5% on the heels of that upside surprise there. Lending Club had talked about loan originations surging 27% from the year ago quarter. So we'll see what SoFi has to say in terms of the lending business. In terms of the actual estimates, we're looking for adjusted EPS of 4 cents on revenue of $637.32 million. And then any adjustments to the outlook as well. Previously, when they last reported, they talked about financial services net revenue growth of more than 80% versus 2023 levels, lending adjusted net revenue of at least 95% of 2023 levels, and then tech platform net revenue percent growth of mid to high teens versus 2023 levels. So we'll see what they have to say about outlook as well. But if you take a look, SoFi shares up almost 3% right now, up 44% this month. And, the year-to-date performance, it was negative year-to-date before the big pop earlier this month. So up about 14% year-to-date, but then 65% over the past 1 year. So as you said, this has been a volatile name, but very much in favor this month.
No reason to think that's going to change around earnings. It is an average price reaction of 12% going back the last few years, Caroline. So it is one that jumps around. Analysts seem to be in disagreement here on this. I see recently you had Wedbush have an underperform at $5, but you've also had Mizuho's Dan Delev say outperform at 14. So I'm sure that the median or the average is somewhere in the middle, but it does seem, depending on who you ask, there's going to be very, very different opinions.
Well, the median is 8, so quite a bit lower than where it's currently trading right now. Dan Dolev at Mizuho, his $14 price target is the street high, and actually raised that price target after Lending Club's results, saying that they portray an improving credit picture. JP Morgan actually boosted its price target as well, saying we are relatively positive into the print for SoFi as we think rate cuts and the return of bank loan buyers will benefit loan sale volume and economics, but they stuck with a neutral rating and now have a $9 price target. So as you can see, SoFi is currently trading above $11 a share right now. 56% of analysts are on the sidelines in the hold camp for SoFi. So Some might say they're missing the bus here in terms of the huge run higher that we've seen. But let's see the reaction to earnings as well and what they actually have to say in terms of loan growth versus potentially just speculating about it.
So, yeah, and I wonder if there's any degree of caution just because we are so well off of their all-time highs. And I know the chart is stellar on a year-to-date and 12-month basis. You zoom out, though, it's a bit of a different picture. This name traded, substantially above where we currently are trading here. Its high is over $28 a share. So is that part of the pessimism that even though we've seen this more favorable interest rate environment, it's still, when you zoom out, it's like what rise to the upside this month? What uptrend? Because it looks relatively flatlined over the last several earnings quarters when you zoom out and see that all-time high.
Yeah, it's certainly all about perspective, right, and how much you're zooming on the chart. That was during COVID, the COVID highs in 2021, significantly higher than where SoFi is currently trading. But for really the past couple of years, it had been essentially flat, kind of bouncing around this $10 and below level. So the fact that it has broken through that, I think, is notable. But again, the highest price target on the street is Mizuho with $14 a share. So only a couple dollars upside and half of where it was trading at those 2021 highs. So I think that's important to note. But again, it all depends on when you get in, right? So if you got in at $28, then you're pretty disappointed. But if you got in, earlier this year even, at $8 a share, then maybe you're riding high on these gains. So I think it's all about perspective. But yeah, a good point. If you zoom out on the chart, it's a pretty disappointing one for those people that have been holding on.
Yeah, and also a great point that it all depends on where you bought things, because obviously we are looking at trading this name, for example purposes, on a more near-term catalyst, which then you probably wouldn't even care exactly what its all-time high once was. You're trading on the volatility we're seeing even today, which market's pricing in $1.40 move in either direction. So we could see some big moves here for SoFi, and I typically tend to think of this one actually outperforming even what the options market's implying. But great insight, great breakdown on SoFi as always. Caroline Woods, senior markets correspondent for the network. And so now, with all this in mind, Alex, walk us through an example trade of this name. I will say the volume on this name is always substantial. It's always on the move, even without earnings. So I actually really like looking at this name. It's one of those exciting, volatility plays into earnings.
Yeah, some things to explore with this one that I think allow for a different conversation than a lot of our example trades. First off, I think it's important to note that excitement that this stock instills in many, particularly next-gen investors, for various reasons. It's volatile, it's maybe a product or service that they use on a regular basis, and also it's a lower priced, more accessible name for that reason. We're actually able to go into the strategy playbook while still being conscious of the fact that some strategies take a little bit more notional value of your portfolio to actually do, and actually perhaps use some of them in this while still being aware that not all next-gen accounts are maybe as big as someone who's a little bit older. And so what I looked at for this example trade is something we don't talk about often, which is the combo trade, or oftentimes referred to as a risk reversal trade. And what it really consists of is selling an out-of-the-money put below the market that can be cash secured, and essentially taking the risk of, hey, if the stock goes down, I'll be a shareholder if I leave this position on and I'm assigned on that put. But I take those proceeds or that credit received and I use it and spend it on an out-of-the-money call. And it creates an interesting looking risk profile, one that takes risk to the downside, but then has unlimited profit potential to the upside. It's going to have a $3 wide range, which for a $10, $11 stock is a wide range, where if it's done for even, it actually just breaks even. So you break even between 10 and 13 in this case. We're in the December expiration, so there's time for the excitement to play out. But you're selling the 10 put to buy the 13 call, all in that December expiration for around zero. Any credit received would be obviously preferred as well. Break even at $10, break even at 13, and everything in between. So penny for penny profit potential above 13, penny for penny risk down to 0 below 10. But really what I would say is you're willing to then buy the stock below 10, and you're going to perform theoretically at expiration like a shareholder above 13. Of course, in between, it's going to be a little bit more of a more of a vertical line like you see where it's going to perform probably like stock a little bit, but a fun strategy, one that if you like a stock lower, you'll have to buy it lower. And if you like it to go higher, you're going to participate to the upside if that happens too. So not a strategy we can always look at because some stocks are just a lot more expensive and it'd be a lot more capital, because you can see that max risk on a cash secured put is $1,000, which is a little bit bigger than some of the example trades we look at.
Yeah, and I think a great way to utilize the fact that we are still trading well off of those all-time highs here. I mean, at $11.28 a share, there's always opportunities to utilize these various price points, and this is obviously where we've been stuck with SoFi this year. So we'll be watching this name ahead of that report tomorrow morning, but we'll leave it there for FOMO. Now coming up next, time to talk actually not an earnings mover, our only one throughout our show. That is Taiwan Semiconductor, which is down 3.5% on some commentary from their founder warning of challenges to their future growth story. We'll dive into it with Kevin Green coming up next.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk Taiwan Semiconductor, and actually a name that's moving without any earnings. We already have that catalyst behind us. We've cleared that hurdle, but perhaps there's more reason to be concerned, at least per their founder. So here to tell us more on this story is Kevin Green, Senior Markets Correspondent for the network. Kevin, I have to say that I see this headline and I'm like, wait a second. All we heard was nothing but positive commentary from their CEO, management on their earnings call. And now suddenly the founder of Taiwan Semi is coming out and saying, wait a second. And this is a little bit of a concern. We're down 3.5% on this news.
Yeah, a little bit of a concern because of further investigations by the United States or even other players within this space when it comes to Taiwan Semi. So for a little bit of a background on this story here, due to an investigation or basically a teardown from a company called Tech Insights, they did find that Taiwan Semi actually had some chips within a Huawei processor, if you will. And so there was a concern, or is a concern, that some of these really advanced chips are getting in the hands of Chinese fab and semiconductor companies, which is against some of the rules and, let's say, restrictions that we have on these chips, which can directly impact Taiwan Semi. And so now there's kind of like a little bit of a back and forth. It's kind of a blame game. Taiwan Semi was the first to actually proactively reach out to the U.S. and then notified them of this particular issue. But they are blaming this company, SoftGo, as potentially the company that provided these advanced chips to some of these other Chinese companies here. So once again, there's a little bit of a fear of maybe some sanction risk or maybe some restrictions or additional restrictions being put on Taiwan Semi. But when you're kind of looking at the story, no one's really taking any type of blame right now. Everybody's pointing the finger at everybody else. And so this is the near-term risk why we are seeing the shares being sold off in today's session. But we have a long way to go to kind of get to the bottom of how these processors were able to get into the hands of these Chinese producers here.
KG, when you look at this general situation of this blossoming industry, TSMC, of course, positively exposed to it when it comes to demand for semiconductors, particularly for the use of growing artificial intelligence. We know that that's a big secular growth theme. Is this a risk that we can see in plain daylight that can slow this down, which is, hey, geopolitical, protectionist, isolated kind of, pushing back on the ease of trade policies? That's first part of the question. And two, if you're a technical trader, you just say, I don't care about any of that. This looks like a breakout retest. This is an entry point.
Yeah, I would say, can this slow down the progress of AI? I think in the near term, but really all you need, especially when you're looking at China, they just need to have enough chips to be able to reverse engineer this type of technology, right? And so over time, I would suspect that they will have some comparable technology that matches what we have here in the United States. Also consider the fact that Taiwan Semiconductor manufactures, over 90%, 95% of all of these AI processors at the moment here. So even if you are going to put any type of restrictions or sanctions on this company, how much is it really going to have an impact? Are you willing to also put at risk your own internal or domestic advances when it comes to AI? So I think there's a little bit of a double-edged sword here, which is why I would not be too concerned about this news hitting the wire for now. And maybe this is going to be a little bit of a retest. I mean, we do have a gap that we're still trying to fill, sitting at around that 190 to 192-ish area. Maybe it does come back, Phil, and you get new buyers kind of stepping in. But since this is a company that is really commanding this space, and it's really the only game in town to be able to churn out these chips in the way that they do, I think it does have a minimal risk to the downside because of this particular action that's taking place. And hopefully that does make sense. But you're not going to find anybody else that's going to be able to supplement what Taiwan Semi can do, not only here in the United States, but around the world.
Yeah, and we've learned that. I mean, even the way that Intel has struggled to recapture some of the competing businesses that they operate. And I think that this name has been the standout, the only really player in the foundry business. So I've always seen them as a bit more resilient. But now as we go into mega cap earnings this week, we'll hear more about CapEx, the spend on AI. Obviously, I've been saying this is a major catalyst for NVIDIA. Do you also see some movement in Taiwan Semi as a result?
That might be the case. So Taiwan Semi also reports their revenue on a monthly basis. So we probably already get a little bit more of a look ahead as to how a lot of these mega cap names are actually spending. Now, the guidance moving forward, the next quarter or 2 quarters or 3 quarters might be a little bit helpful when it comes to stock price appreciation. But once again, we get high frequency data. I consider high frequency data on a monthly basis for Taiwan Semi. We know where the tides are going. And then we also get macro data from Taiwan as well that actually has a line item for semiconductor, imports or exports, if you will. So there's enough data out there to really track the trends that we were seeing in the semiconductor space. I don't think it's as helpful for Taiwan Semi, but it might be a little bit more helpful when it comes to NVIDIA, a lot of these forward guidances that we're going to get for CapEx from big names like Google and Meta.
Do you think there's more shoes to drop with things like what we're reading today within this kind of geopolitical spat, or is it just one of those situations where it's kind of built into the risk premium for this type of a stock?
I don't think it's built into the risk premium, but once again, I mean, there's no one else that can do what Taiwan Semi can do. So you can be tough on them for this situation up until a point, but they still have the ultimate leverage over any other company or any other country out there that's trying to expand AI. So we also have to kind of keep that in mind. Yes, it's a kind of a black eye. You don't really want to see this, but where's the U.S. going to go outside of Taiwan Semi? Nowhere. No one can compete with them, not in the short term. You're going to need 3, 4, even 5 years in order to try to even be close to trying to ramp up production domestically here in the United States in order to supplement this issue if it were to continue, if that makes sense.
No, that makes perfect sense, and I think that that's a great point. And that's the argument I've been making. Like, I don't know why they necessarily trade lower on some of these reports that are negative from like these ancillary AI companies, because to me they are one in their own somewhat. But we'll leave it there. Great insight as always, and an interesting story today. Taiwan Semi, Kevin Green, senior markets correspondent for the network. Now, coming up next, last but not least, it's time for Under 30. We are talking Ford, which is actually making a pretty decent move to the upside to kick off this week, but we have earnings out after the bell. Will we see a GM type response, or will we see more of the same from Ford, and if it's down 7% on the year?
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network. Investing. It's time for Under 30. Today we're looking at Ford Motor ahead of its earnings release. Joining us to help preview that report is George Tillis, senior markets correspondent for the Schwab Network. Good afternoon to you, George. When we look at a name like Ford, I think a couple things always stick out. One is kind of the low PE that, you know, perhaps is low for a reason, though, George. This has always been kind of what I see as almost like a value trap, because it doesn't seem to go anywhere. Building on the fact that it had a pretty abysmal earnings release last quarter, is there a little bit more, risk around this report?
Well, I think the last report there was a lot of disappointment, and the stock has really reflected that. We talk about this stock quite often, and I mean, you bring up a great point. This is a great example of why you shouldn't just look at a low forward PE. In this case, it's around 6 times earnings for this year, next year, and for 2026. So that's telling if you actually see your forward PE in the next 2 years basically the same as the current year. There's just not a lot of growth. Now, when you don't have growth in terms of earnings per share, or EBITDA growth, you typically will see stocks trade somewhere in the mid single digits to sometimes the high single digit multiples. So this stock can oscillate between a forward multiple around 6, maybe to 9 times until it demonstrates some significant earnings growth. Now, for this quarter, they're expecting quite a good quarter. If you look at the earnings estimates on an adjusted basis, 47 cents is the print expected versus 39 cents for the same quarter last year. So that's a significant increase. But sales growth is very tepid, less than 1%. coming in around 41.95 billion. And if you look at last year for the same quarter, it was around 41.8 billion. So you're not expecting too much growth for the business. Ideally speaking, we talk about this business in terms of the debt that they have on the balance sheet. Well, if you exclude the finance division's debt, basically it has corporate debt of around 18 billion. But at the same time, they have about 26 billion in cash and cash equivalents. So that's actually a good sign. But I think the problem for Ford is, they've got a lot of commercial truck business. Their EV fleet isn't really taking off like it has, but they're actually one of the leaders out of the big three U.S. automakers in the hybrid technologies. So, I placed them second behind Toyota, maybe third behind Honda and Toyota in the hybrid space. But I think the elements to the business is it's just not growing. Now, that's not necessarily a bad thing. But the thing about the stock price is that I think that the company needs to do something to pacify investors in some capacity. Now, they could pay down debt with the cash. They could certainly use the cash to pay a special dividend, buy back some shares. So I think that might be something the company does report. But the reason it's not performing like General Motors is that it doesn't have the technology division, the autonomous driving technology division that GM does. And so if you have a growth area of their business, you're going to trade at a higher multiple, which GM is. But at the same time, this stock, for the lack of a better word, has been stuck in the mud in the past 3 years. The trading range has been between, let's say, $10 and $15. And every time it gets to that high end of the range, it sells off. Every time it gets to the low end of that range, it gets bought up.
So is the concern here, because I know they do have an entry into the EV space, and I know that there is that element of growth there, but is it just the matter that they haven't invested in the same extent that GM has? Because I will say that GM was a story of it felt like short-term pain for long-term gain. Ford, it just feels more of it's been a lot of the same, like you said.
It has. And now the companies are investing in EV, but so is every other automaker. So if you think about the nature of the electric vehicle market, and Tesla, again, is indicative of this, they over the past 2 years have been, suppressing prices, dropping prices. And, when you talk about volume of EVs, they're a small percentage of the total fleet sales for both Ford and GM. So they need higher prices, but they just can't sell them at very high prices. Now, some, of course, will pay those higher prices, but in general, they're just not generating the volume of sales to offset the R&D costs associated with EVs. So, the mix of vehicles now is very important. If you look at Toyota, because I follow them closely, they've actually got a great mix of, turbocharged hybrid combinations. They don't have a pure EV, and their stock has done it very well. Same with Honda. So I think that the narrative here is the companies that focus more on hybrid technologies right now may end up paying off. And Ford, I think, is number 3 if you were to compare Toyota and Honda as two of the Japanese leaders. So unfortunately for Ford, it's just not growing. And the multiple reflects that. And I'm going to go back to what Alex said. It may be a value trap, not a bad company, not a bad profitability profile. There's just no growth. And if there's no forward growth, you actually see your stock just trade in a trading range.
And I think that's exactly what we've seen, frankly, especially when you zoom out. You can just see that lack of growth and see that lack of catalyst, it feels like, to the upside. So totally agree with you, and we'll leave it there. Appreciate it. George Tillis, Senior Markets Correspondent for the network. And we're ending the show, a lot of where we just started. Strength led by V. Russell here. That'll do it for Next Gen Investing. Coming up next, we have the Watch List, today hosted by Caroline Woods.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The
market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see pattern. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Good afternoon and welcome to the Watch List. I'm Caroline Woods in for Nicole Petalides. It's 2 p.m. here at the New York Stock Exchange. I'm live from the floor, and here's what we have coming up on today's show. We're looking at a huge week on tap with a third of the companies in the S&P 500 set to report earnings. Of course, ahead of October jobs report on Friday. We'll also talk some recent AI trends and which companies are making a big push in the hybrid AI space. And our panel talks restaurants ahead of earnings. Reports from McDonald's, Chipotle, and Starbucks all are on tap this week. Let's take a quick look at the markets with only 2 hours left in the trading day, and stocks are kicking off the week on an upbeat note. The Russell is leading the way higher, as you can see, up about 1.7%. The Dow up about 317 points right now. Boeing a weight there, but being offset by some gainers like 3M. Big tech is mixed. The NASDAQ is up about 0.3%, but we've seen Tesla, Microsoft, Nvidia, and Netflix all turn negative. Meanwhile, the S&P 500 also higher, up about 0.5%. Financials and utilities leading the way. Let's take a look at some of the futures products. Crude oil, a big downside mover today. As you can see, crude oil down almost 6%, trading below $68 a barrel. Gold and the dollar basically flat today, but Bitcoin making a move higher, up about 3.5%, inching closer to the 70K level. For some of the biggest stories in the markets, let's welcome in Kevin Hinks, co-host of Fast Market here on Schwab Network. Kevin, thanks so much for kicking off the show with us, and it's a really busy week ahead. So I'm curious, how do you think traders should really approach this week, given that there's so many potential catalysts that aren't exactly happening today, but are certainly on deck?
Yeah, hey, Caroline, if you look at this week from in its entirety, it's intimidating. with all the economic data and earnings coming out. 5 of the Magnificent 7 stocks coming out with earnings. And then a bunch of top tier economic data. The key is to look at them one by one and look at them as they come. And it's like the old saying, how do you eat an elephant? One bite at a time. You have to look at each one as they're coming. The first ones we're going to get tomorrow morning, we'll get JOLTS data, consumer confidence, some house price numbers. Then we get into Wednesday, we'll get ADP and GDP. That's important. Thursday, we'll get personal income and outlays, a good look at inflation, and then Friday's payroll data with another look at inflation. And then earnings are going to be incredible. So the key is, on a week so stacked with data and earnings, to go one day at a time and trade what's right in front of you. Don't look down the calendar because it's just more and more intimidating, Caroline.
Kev, stocks are higher despite a tick higher in the 10-year yield. This has been kind of a theme lately, currently trading around 4.29%. How important do you think the economic data is going to be this week? Because it seems like the rates shouldn't be ticking higher if the Fed is actually in this cutting mode. So if the jobs data comes in too good, if inflation data comes in hot, could there be some disappointment here in terms of where interest rates are going?
Yeah, I mean, we're going to get PCE data on Thursday and wages data on Friday. Not just the strength of the U.S. economy, but inflation as well. And some of the inflation numbers, frankly, have been starting to creep a little higher, or at least firm up. The wages data for Friday, year-over-year wages are supposed to be 4%, unchanged month over month, again, after ticking up last month. So there's no relief coming in terms of wages on inflation data. So we'll get some PCE data. But yeah, there's a lot of questions still. And look at the move in the 10-year yield since Jerome Powell cut the Fed funds rate by 50 basis points. They've gone straight up. Why? Because the overall economy, right? Remember, the shorter term yields have moved down, but the longer term that reflect the strength of the U.S. economy have all ticked higher in terms of yield. So it's an interesting problem for the stock market to have. The stock market doesn't mind higher rates as long as they're not spiking, Caroline.
Okay, so is good news bad news, or is good news back to being good news?
I think good news is good news for the economy as long as it doesn't start to heat up. I mean, if the inflation data is firm and the economic data is strong, I think that's good for the overall economy, as long as the 10-year yield doesn't spike and the dollar doesn't spike. But what happens if earnings start to really beat and the economy shows strength? There's a lot of things. The byproduct of that can be higher yields, which makes stocks a little less comfortable at these levels. Because let's face it, we are at fairly high levels for the overall valuation of the S&P. If someone tries to tell you that this is different this time, it never is, Caroline.
Yeah, and we have 5 of the Mag 7 reporting this week, as you said, and the bar seems pretty high given how much so many of these companies have run, including Apple, which is up another 1.2% today on the heels of this Apple Intelligence rollout, really the first wave. Also some announcements of about a new iMac. Shares were already higher, but adding to those gains after this official rollout. So it seems like investors are happy with what they see, Kev?
Yeah, Apple's, there's going to be an excitement because they were disappointed when they released the phones without the Apple Intelligence. Now they're starting to roll that out in an iOS upgrade. You know, Apple still got some problems with expectations are very high and valuations are very high. So when it comes out with earnings at the end of the week, expectations, the bar is going to be pretty high for Apple. They've got to show that this new iPhone, the 16, which will include eventually Apple Intelligence, they got to prove that that's going to bring home the money, because this stock has rallied a long way on anticipation of this iPhone and the upgrades that the 15 and the 16 have to do. So yeah, the bar for Apple is extremely high, and they've got to deliver on these, or you start looking at valuation, and the valuation for Apple at a 35 plus PE is rich. Caroline?
Okay. Yeah, no, I was talking to Dan Ives this morning, and I said, hey, Dan, I haven't upgraded yet. I don't plan to unless I need to, but he maintained his bullishness. So, one other quick thing, Kev, I want to ask you about, too, is this is the last full week before the election.
Sure.
And, I was talking to Peter Tuchman earlier today. He said that he thinks this is basically a market that's heading higher regardless of the outcome. But how should we factor in some potential volatility heading into the election, and then, of course, the potential outcomes next week?
Yeah, a lot of times these elections go as played out, right? With the 2016 election, remember, that was a volatile evening. Futures sold off early in the evening and then rallied all the way back before the open. But they were down 5% to up by the time the stocks went. So what I'll be doing the night of election, watching the results come in and watching futures. Caroline?
All right. We have, 8 days to go.
Yeah.
Kevin Hinks, thanks so much. All right, now let's take a look at the bigger picture and stocks for you to consider with David G. Dietz, Managing Principal and Senior Portfolio Strategist at PPAC Private Wealth Management. David, thanks so much for joining the show. Great to have you here.
A pleasure to be with you, Caroline.
All right, so as I was just talking about with Kevin Hinks, it's a big week, especially for big tech. We, of course, saw Tesla shares pop 20% after earnings. Do you think the other, 5 of the Mag 7 that are reporting this week can measure up?
Well, I think it's going to be a stock-by-stock thing, but certainly as an investor, you've got to hope that they come in high here, because, if you strip out the 10 largest mega cap stocks in the S&P 500, instead of having a 4% year-over-year growth, you come in flat for the S&P 500 relative to the other 490. And of course, that's flat before you factor in the inflationary effect, which should take everything down about 3% from a real perspective. So let's hope that these mega caps come in with nice reports.
We'll also get reads on the labor market and inflation, of course. How are you factoring in economic strength into your overall market forecast? How are you looking at the economy? As strong as the data is pointing to?
Yeah, so, from a stock investor's point of view, we want that strong data. We want an economy which avoids any type of landing whatsoever. We want to see as many people have jobs. That's manna from heaven for stocks. Of course, the problem is the flip side is we've got a Federal Reserve which has talked about reducing interest rates, but to the extent that a higher and stronger economy and a stronger labor market keeps the pressure on inflation higher for longer, they're going to be less inclined to reduce interest rates, which is one of the key pillars driving this bull market here with the S&P 500 up 24%. So I guess at the bottom line is we really want a Goldilocks. We want indicators showing economic strength, but not inflationary pressure.
Is that what you think we'll see? Are you in the no landing camp? And ultimately, what do you think it means for the Fed's next moves?
Yeah, so at this point, I'm in the no landing camp, absolutely, because what we're seeing here is despite interest rates which are much higher than inflation, meaning real interest rates are very high, most of the problems have been limited to some of the big ticket items, for example, real estate, for example, automobiles. But given we are such a service economy, we are, in terms of GDP and overall economic growth, we're just not seeing major effects here. And of course, the Fed has our backs here. They have promised to lower interest rates. I think they ought to. And so I think that gives you an additional tailwind to believe that we're going to avoid any nastiness in terms of an economic hard landing.
Okay, so in terms of sectors you like, I guess no surprise if you really believe in this economy that you like small cap stocks, but you're also looking outside the U.S., it sounds like, international and emerging markets. Tell us why. Is this purely valuation based?
I think it's a valuation base for sure. The dividends are up to 3 times higher in Europe, for example. Your second largest economy is China, where your valuations are up to half of what they are here. They say don't fight the Fed because the Federal Reserve ultimately can juice the U.S. economy. But over there, we're having to say don't fight the Chinese monetary authorities and don't fight the Chinese fiscal authorities who are pulling out all the stops to restart their economy. Of course, from a GDP perspective, they're growing faster than we are anyway. And so, we are starting to see since September, Chinese stocks do very, very well. As the second largest economy, that's going to have a positive halo over really the rest of the world, including the Apples of the world, the Teslas, the consumer products companies here who sell into China. So I think that's a big positive, too, for investing outside this country.
Okay, you also like real estate in terms of sector pick, but in terms of stock picks, I do want to get to these because you like some beaten down names, so I guess you could say these are value plays as well. First one that I want to ask you about is Intel, because Intel, of course, it's actually higher today, but it's been incredibly beaten down more than 50% year to date. What makes you bullish on a name like Intel other than the fact that it's beaten down?
Well, I mean, it's not just any beaten down stock. Of course, it is a Dow stock. And when you look at the geopolitical landscape and our critical push by this country to get one of the key industrial and technology items built in this country, it's all about Intel because they have the facilities here. So it's really not only, I believe, too big to fail, but it's too important to fail. They've already collected about $10 billion from the federal government in terms of the CHIPS Act to build more foundries here. It is number one, of course, for servers and for personal computers. It is lagged, admittedly, in terms of AI, but that does not mean it is out. You just start looking at the valuations. Again, you've got NVIDIA at 3.5 trillion. You've got Intel at just 100 billion market cap. It's just 1/35th. So there's just a lot of room for improvement there. I also, Caroline, really like to look at price to sales because people can manipulate earnings depending on how much they invest in capital expenditures, things like that. NVIDIA is trading at 35 times sales. Intel is just trading at 1.7. And how about the other ones? Their competitors, Qualcomm at 5, Advanced Micro Devices, which used to be a poor cousin to Intel, nearly 11. Even Micron Technology, which has been criticized in the past for being a commodity semiconductor maker, at 5. So Intel is just so undervalued, and it doesn't have a debt problem. And they've got so many different divisions that they can sell off. They've got a lot of pieces to get just back to their 52-week high of 51, which would be far more than a double from here.
Okay, and just finally, you also like Genuine Parts and BHP Group. We're almost out of time, so just give us a brief reason why for those.
Genuine Parts market leader in terms of manufacturing parts and, of course, for automobile. This is a company that's not just a dividend aristocrat. It's a dividend king. It's raised that dividend 68 years in a row, now at 3.5%. Had one bad quarter. I think it can get back up pretty easily as long as the economy doesn't have a hard landing. BHP, that's a chicken way to play China because they're the number one in terms of commodities. China is a huge consumer of commodities, whether it's iron, whether it's copper, of course, for the Green Revolution too. It's also been down this year, above average 5% dividend. I think this is a great way to get exposure with the commodity king on the planet, BHP.
All right, David Zietz, PPAC Private Wealth Management. Thank you so much for your picks and your insights.
Thank you, Caroline.
Have a good one. Coming up, it's time for Options Corner. Rick Ducat joins us to highlight unusual options activity from the day and how investors are looking to trade on recent news of Investo's QQQ ETF, Estee Lauder, and VF Corp. Stay with us. We'll be back with that and more.
portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. It's time for Options Corner, where we analyze unusual options trades seen throughout the day. For that, let's welcome in Rick Ducat, Chartered Market Technician at Schwab Network. Rick, great to see you. First up is an ETF and a lot of retirement accounts. Tell me about the bearish play you saw for Invesco QQQ Trust.
Right. I mean, and we're looking at the NASDAQ, basically. This is what the QQQ reflects here. And it's a big tech earnings week coming up here on semiconductor, Cadence, F5, KLA, Tencor. But the big ones, obviously, Google, Meta Platforms, and Apple, all this week here. So it's a really big week for tech. However, this trade, it's been on the move to the upside lately. QQQ kind of stalling out. Looks like the pace of the gains is kind of slowing down. Haven't really cracked those previous highs near 503. And, the big caveat is that earnings could change all that this week. But at least one trader does not like the prospects for the tech sector over the next quarter. So let's look at the trade. Plus 5,000, January 17th, 485, 424.78, put vertical at a 928 debit. So they're buying the 485 strike, selling the 424.78 strike in equal increments, both 5,000 lots there. So we can see here that, this is a pretty hefty bet here. This trade stands out for two different reasons to me. The trade itself is straightforward. It's just a put vertical here, but the size is first. It's about $4.6 million to put on this trade here, and that would be the max risk as well. That would be what they would stand to lose if things don't work out here. And the second is the width of the strikes, very far apart here. So I almost wondered, why did they even bother including the 424.78 strikes? But when I looked more closely, they were still able to sell them at a $3.11 credit, $3.11 credit. So even though it was extremely far away, they were still able to defray some of the cost of those long options there. So this trade, break even comes in 475.72, about 4.2% to the downside here. So to get to the max profit though, that other area there near 425, a 14.3% drop. So expected move by the end of this option series in the 81 days, about $44. So the max profit area, pretty far beyond that range here, but the profitability area, the break even, easily within that range here. So, this one could work out pretty nicely here. And, just one other interesting thing, there was another person out there, someone was buying puts in the January 17th expiration series, once again, about 15,000 contracts at the 129.78 strike. So someone out there is looking for a trade that would need a 74% drop to pay off in the same time frame here. So not a lot of love for the Qs over the next quarter, it seems like.
Yeah, wow, that would be pretty notable. All right, so it's not just big tech on tap for the earnings calendar this week. We're also going to hear from Estée Lauder, which reports earnings on Thursday. You found someone with a bullish play on the name, and this is a name that hasn't gotten a whole lot of love this month or this year, so fill us in on this one.
Yeah, it's been kind of a tough chart here. The big news for this one today is a new CEO. The current executive group president is going to step up when the current CEO retires, and you can see when you look at the chart, mostly sliding downward, but you can see that little peak, close to where we are now, near the end of September or so. So we can see that was the recent highs. Keep that area in mind here. I'm going to call back to that later. But quite a bit off the highs we saw from this morning. Still up 1.7 or 0.7% on the day. So faded even more since I wrote that down here. So someone is looking for a big bounce though. The trade here plus 2,232 March 21 95 strike calls at an 830 debit here. So 144 days to expiration. A hefty premium paid for these long options here. Pretty pricey. And the break even 103.30. That would be 16% to the upside. That's roughly where that peak that I was mentioning earlier on our chart lines up there. So they're pretty much looking for price to go above that area and continue on with this particular trade. So plenty of time, but we do need, like I said, a pretty substantial increase in price. The good news for this trader, the expected move is more than 22 bucks here. So the break even, once again, pretty nicely within that boundary there. Total options in this name, about 14,000 options traded today. So this trade represents like 16% or so of the total options volume. So it stood out to me that someone put this kind of outsized trade in, as we head into this earnings event here. So could be an interesting one to keep an eye on.
Okay, so Estee Lauder getting a little bit of love today, up about a little less than 1% right now. The final unusual options activity you found was on VF Corp, which reports after the bell today. Actually, you found a bull for VF Corp as well, and this is another one that not quite as disappointing as Estee Lauder's chart, but it's been underperforming the broader market. Fill us in on this one. Yeah,
earnings today, that's the big story. Not a lot of other news in this one, really, as we kind of dive into it. Some price target changes here and there, but, pretty much old news at this point here. So this trade is once again fairly straightforward. Plus 6,000 November 1st, 17.5, 20 strike call vertical at a 70-cent debit here. So, a bullish trade, obviously. Break even 18.20, about 5% to the upside. Total risk 420,000 bucks. Not the biggest trade we see. I normally try to look for very large ones here, but we do have this earnings event today. It seemed like it was a timely thing to look at for this one here. So max profit a little over $1 million, and this is a short-term trade here. They've only got 4 days for this one to play out. So that kind of adds a different element of suspense, I would say, to this one here, because the less time you have for things to work out, the more likely it's going to be kind of an all or nothing trade. You either make the profit or you take the loss here. And we can see as well that the expected move is about $2.14. So once again, like kind of all of our trades, none of these are big moonshoot trades that are improbable. All of the break evens for all these trades today, mostly pretty much within the boundaries that they're expecting. The max profit, though, is a bit out of reach by this measure here, but still, certainly possible here. About 1 to 2.5 risk versus reward, a fairly typical setup for this type of trade here. 75,000 options traded in this name today. The sizzle 3.9 times the 5-day moving average of volume here. Coincidentally, just like our last trade, this one's about 16% of the total market today.
All right. Well, taking a look at VF Corp, shares up almost 3% today. Rick Ducat, appreciate you breaking down that options activity for us. Coming up, we're putting AI in the spotlight, some takeaways from some recent news for some of the biggest names in the space, and the next technological advancement investors need to be watching. We'll be right back.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Caroline Woods, live from the New York Stock Exchange. Let's take a quick look at a few movers in the market right now. Crude oil is on pace for its worst day in 2 years after news broke that Israel's weekend strike on Iran did not damage any of the country's energy facilities. Citigroup lowered its Brent crude target to $70 per barrel from $74, citing the lower risk premium. The drag on crude has the energy sector as the biggest laggard in the S&P 500 today. Airline stocks, though, are getting a boost on optimism of reduced fuel costs. On semi shares, rebounded after an initial drop on its mixed earnings news this morning. The company actually topped expectations for both earnings and revenue for the third quarter, but its estimates, her guidance for the fourth quarter came on the low side of analysts' expectations. The company is predicting a growth in the EV segment, which is a core part of its business. For the year, on semi is down about 11%. For some more market trends to watch in the chip and AI space, let's welcome in our next guest. Zeno Mercer is Senior Research Analyst at Vetify. He joins me now at the desk. Zeno, great to have you here.
Thanks for having me.
It's certainly a big week for big tech, and AI, of course, will be a central focus when all of these, 5 of the Mag 7, actually report. So help set the stage for us, just in terms of your expectations, in terms of what we should expect to hear about AI. Is it this just continuing to spend, or will we hear more and more about monetization?
Yeah, I think, from a game theory perspective, none of them are really going to pull the brakes yet on spending and CapEx on deployment. For monetization, you're hearing lots of their AI labs and new products pushing forward. We saw Google Jarvis pop out about their new AI agents coming out, so a side project. But really, we're looking for just increased clarity on the CapEx deployments in the U.S. We obviously have had other big news in the last couple of weeks from Taiwan Semiconductor's fab plant in the U.S. with positive yields. So if you're kind of tying in what is this 5-year story looking like, we obviously are looking at earnings this week, but really it all kind of ties into we have to go back into the supply chain, and if they want to actually keep building these out for years to come, they want to have this, there's a whole ecosystem that goes into play. But we're not really expecting anything out of the ordinary, just expecting no major we're not expecting anything unusual to come out. I think the analysts are going to be pretty on target, and we're going to keep seeing spending here.
It's just a matter, I think, of if the bar is too high in terms of how the stocks will actually react to these reports, even if they do come in line or better than expected. You mentioned the news out of TSMC. What were the biggest takeaways from that in terms of overall chip demand?
There have been a lot of fears that they wouldn't be able to recreate their productivity here in the U.S., and it's really important because we're going to have higher base cost over here. So construction and manufacturing ongoing costs are just higher here. So the ability that these yields are higher is a really good signal that we're going to be able to de-risk that, and be able to build in America. So I think that's a major thing. Obviously, they've had some pull through from the CHIPS Act, and there's many more 3 or at least 2 more fab plants expected to come on over the coming years to service this growing demand for AI chips and the integration and requirements that are ahead.
What does that mean for Intel?
Yeah, further not generally good news. Again, they're not really leading the way here. They're not pioneering. In our Think Artificial Intelligence Index, which we launched in 2018, we've never added Intel to the index. We never saw it as a leader. And clearly it has a lot of figuring out to do here.
But does have government money, or is expected to get government money.
I think I made a joke the day they got $8 billion. I was like, my stock would be up higher. Their stock was down the day they got announced $8 billion, I think, in funding.
Right,
yeah.
right. Although a guest earlier in the show did have Intel Intel is a pick. So there is some bullishness out there. In terms of the news flow, Apple obviously in focus today. We were talking about this during the break. You have the iPhone 15, so you've been able to play around with some of the new
I'm on the beta.
Apple Intelligence beta features. What's your takeaway so far? This is our channel check here.
Yeah, so I mean, I find some of the summaries useful, but everything I'm seeing is something that every other player will be able to do, right? So right now, most people use AI as a interface like we do with Google Chat, right? It's a one-on-one. The future of AI and AI agents is being able to integrate directly into the data, so kind of APIs and databases. So a lot of companies that expect, Apple Intelligence to be this new revenue cycle, I mean, the bar is just rising for everyone. So we actually think there's more competitors going to be able to compete with Apple. But sure, it's going to be a net positive for everyone out there to be able to spend less time navigating user interfaces, have more content tailored to you. It's generally a win-win. I mean, they're obviously partnering with ChatGPT, so they kind of have this hybrid situation where they're doing Siri locally, and if they can't solve that problem, which that's a problem in and of itself, like understanding what you can and cannot do, that's important for humans, that's important for these, personal AI devices. But I mean, we're heading to a world where we do have hybrid AI, where these local AI models are able to be very competent and then, can signal to the cloud. But increasingly, that might reduce dependence on cloud models as these local models get better.
So talk to me about this, because you say the future is hybrid AI. Explain to me what that actually means, and then who actually benefits from hybrid AI in terms of companies.
Yeah, well, society benefits because it's going to reduce gatekeeping of a lot of services, technologies, reducing friction. I mean, a 5-year-old and my grandmother, who's was 100+ years old, should both be able to interact with technology, be able to not search and be flustered. In terms of companies, well, companies like this year alone in the Think Index, we've reduced our holdings into companies like, we actually reduced positions in Salesforce and Wix. And that's because we're seeing more and more kind of AI to AI integrations, and that, as I mentioned, we were talking earlier, these AI agents can navigate human design websites, but those are kind of clunky for these companies. So we expect to see more, I need a task done, it'll go directly to the source and not have to navigate the kind of clunky interfaces that we have today. And also from a technical positioning moat standpoint, people are looking at, Salesforce might be able to monetize these agents. Well, everyone's able to make these agents right now. Like, that is becoming table stakes, and also the bar is rising for everyone. So not necessarily seeing a competitive, like we're seeing moats erode for some of these companies where kind of this, as we're automating more things, and as regulation requires this to be deployed, I mean, the U.S. is exploring using AI in the government. One of the biggest areas they're looking at is like, how do we make sure that this is not only fair and biased and working, but how does it fit in the regulation? So we're more bullish on companies providing that observability layer, like Datadog. So we've been increasing, kind of what does this tech stack of the future or near future look like?
And these AI agents that you speak of, I mean, where are we actually seeing those right now? Because we're not seeing them on the iPhones with these new Apple Intelligence updates.
No, so these AI agents right now are kind of coming in the form as kind of first tier or low-hanging fruit of knowledge bases for workers at companies, or even chatbots. Mm-hmm. So we're seeing that for customer service. We're seeing that integrated. Now we have voice capabilities with a lot of AI agents, so they can actually intake flows. So instead of getting to a phone and press 1 if you want to hear more, we're going to be able to communicate. It'll understand intent and get you to the right place faster, the answer faster.
So who still has room to run then, in terms of, because obviously we're seeing the AI power play, because all of these systems take a lot of power.
Sure.
The chips, we've seen the NVIDIAs of the world obviously benefit in a huge way because of the chip strength. Are there any other plays that haven't, seen the benefits yet?
I would say some of the winners are less clear in terms of some of the current leaders in that space. Twilio, for example, there's a lot of API calls and working with telecommunications, but again, we're entering a new paradigm where, if you look at the biggest companies of 1990s before the internet took off, they're not the same companies today. So we're again looking at companies that are positioned for kind of two different tangents of outcomes, whether, open source AI takes off and everyone, AI becomes utility and democratized. That's one angle. So again, looking at infrastructure players that provide the backbone to these. So less so kind of the application layer so far.
Okay. And then just to bring it back to Apple, because that's obviously a key focus this week and today, anything that you've seen at this point playing around with beta that would cause an upgrade cycle, this huge upgrade cycle that the bulls are hoping for?
No, and they're going to be very careful. They don't want to see anything catastrophic come out, but so far nothing has been, it's clear, like there's not a huge major upgrade cycle coming, and they're not even operating, I think, in parts of Europe now because of regulation concerns. So, and in China, they're going to have to play ball a little differently with local partners. So it is a little bit more complicated than that, the story that a lot of people are saying about this upgrade cycle happening. I think we're going to have to wait and see. There's not that big of a difference between a 14 and a 16 right now. So I don't think it's there yet.
Okay. All right. We'll leave it there. Zeno, really appreciate your insights. Thanks so much for breaking it all down for us. That's Zeno Mercer from Vetify. All right. Still ahead, we're taking a closer look at mid-cap, some of the stocks that stand out in the space, and the strategy behind the mid-cap fund after its strong third quarter returns. We'll be right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Caroline Woods. It's a busy week for earnings, especially for the mega caps, but we're taking a moment to look at an overlooked area, an often overlooked area, and that's the mid-cap space and some potential opportunities there. Joining me for that is Lori Keith, Director of Research and Portfolio Manager at Parnassus Investments. Lori, thanks so much for joining us. And before we even start, tell me, is that the right pronouncer for your company name?
It is indeed. Thank you so much for having me. It's great to be here today.
Well, it's great to have you as well. So, as I said, we're going to be talking a lot about big tech, but it's always good to focus on some other areas of the market, especially where people are finding opportunities. And you like mid-caps. So tell us why.
Sure. I mean, I'm extremely optimistic about mid-cap stocks. They've obviously had a really solid year to date. But we think, as you mentioned, they've really been overlooked as well relative to the Magnificent Seven. These names, large caps, certainly have excellent fundamentals, with significant competitive advantages, strong white votes, impressive growth rates. At the same time, we know that these businesses can't grow forever, and at some point, the law of large numbers will come into play, and eventually slow down some of their returns and growth prospects. At the same time, we think mid-cap stocks are really in the sweet spot of the market. And given that it's been overlooked, I would say a couple of things really make it attractive. First, mid-cap stocks really trading at a discount, 20% discount right now to the S&P 500. This is a level that we've only seen really 2% of the time since 2000. So very attractive level. Also, it's especially attractive when considering the 2025 growth rates for the mid-cap Russell Index is actually higher than the S&P 500. I'd also say what I love about mid-cap stocks is, they really have proven financial models, often really seasoned management teams, and yet they're also small enough to have a really long runway for growth. So this allows them to generate, really excess returns for a long time. And then finally, I would say, is really the mid-cap space is very diverse. Essentially, there's about 800 companies on the Russell Mid-Cap Index. So concentration risk are much lower relative to the large cap index. And, when you consider that mid-cap stocks, the largest constituent is typically no higher than 50 basis points relative to the S&P, where a handful of stocks really make up, roughly about a third of the index. So in the mid-cap Parnassus mid-cap strategy, we really focus on 40 to 45 stocks that we think are the highest quality companies within the universe, and own them for a long time. We're not chasing fads. We're looking for really resilient companies that can grow for multiple years in the future, that eventually can become large cap stocks and deliver strong returns over a full economic cycle. So that's how we approach it.
Okay, so you made a good case for mid-caps. I want to talk about some of your actual picks that I know are in your fund as well. But before we get to that, it's clear that you expect to continue seeing this broadening out of the market. I'm curious, do you think it's at the expense of mega-cap, especially mega-cap tech, or do you think it's in addition to?
I really think it's in addition to, obviously, as I mentioned, the large cap Mag 7 and the other large tech stocks have very strong fundamentals. But at the same time, there is a limit in terms of how high they can eventually grow from our perspective. So we think it's a broadening out of the market. And as I mentioned, we think it's overlooked because there are a lot of very strong mid-cap companies that have strong dominance within their respective market segments that we think can also deliver significant outperformance over the long run.
Okay, so you have the Parnassus Mid-Cap Fund, ticker PARMX. Tell us about either what that's comprised of, or if you can just give us some of your top picks in the space, in terms of mid-caps, fill us in there.
Absolutely. So I would say, first of all, what we're looking for in terms of criteria is we're looking for businesses that have really sustainable competitive moats, increasingly relevant products and services, management teams that are aligned with long-term shareholders, and we also pay close attention to their sustainability factors. In other words, how do they treat their workers? What are their safety practices? These are vital aspects for companies' resiliency and ability to deliver long-term growth. So, one of the areas that we've seen particularly attractive, we've done quite well in for many years, is in the software sector. We own companies such as Guidewire. Guidewire is the largest provider of cloud-based software for the insurance industry. They really provide that mission-critical core processing, payment solutions for property and casualty providers. And that dominance really gives them that scale to really be able to invest behind the business, both in R&D as well as in their human capital, to drive even further growth, excess returns relative to peers. We've also been involved with companies such as a Workday or Autodesk. Both of those companies are also very dominant leaders within their respective industries. They have significant scale and they have a long runway for growth. Autodesk, as an example, really the dominant player in the design market for architectural and construction And Workday really leads in that cloud-based human capital management financial software area. So we think that scale really gives them that ability to invest and support that long runway for growth.
I also see D.R. Horton and Sherwin-Williams on list of stocks that you like, and those are names that obviously would be interest rate cut beneficiaries, but they have pretty impressive one-year charts. If you take a look at the one-year chart, D.R. Horton up 76%, Sherwin-Williams up more than 50% over the past 1 year. So you still think that there's room to grow, and the potential for interest rate cuts isn't already priced in at this point?
We do. I mean, we think, D.H. Horton certainly is a very good beneficiary of long-term trends around supply and demand imbalance in housing. As we sit here today, we're roughly about a 4 million unit deficit in terms of housing in the United States. And D.R. Horton, really being the largest home builder, really has that scale. So they've been able to capitalize on that to provide really a range of housing solutions, affordable price points for home buyers. And we also think that long term, as that demand continues, obviously as rates are coming down, that should be also a tailwind for the company. But we think their scale and their advantages, they're really being able to invest in their products as well as providing attractive price points for home builders, makes it attractive company. I would also highlight Sherwin-Williams really also benefiting from the home remodeling. It's certainly in recent quarters, it's been, I would characterize as tepid demand, but we think as home builders are aging in place, significant number of new millennial buyers coming to the market today, that really creates a nice runway for additional demand as they purchase paint from the leading manufacturer in the United States.
All right, we have to leave it there, but appreciate your picks and you helping us to diversify the conversation a bit. Lori Keith, Parnassus Investments, thanks so much.
Thank you so much.
All right, still ahead, we'll bring in our panel to discuss restaurants. McDonald's, Chipotle, Cheesecake Factory, Starbucks all report earnings this week. We'll take a look at what to expect. Stay with us. We'll be right back.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to the the watch list. Tomorrow morning will be a busy week, or a kickoff week, for restaurant earnings, with McDonald's the first big name to report. We'll also hear from other giants in the space like Chipotle, Starbucks, and Cheesecake Factory this week. Let's bring in our panel to discuss it all. Nick Setien is Managing Director, Equity Research Restaurants at Wedbush Securities, and RJ Hadavi is Head of Analytical Research at Placer.ai. Nick and RJ, great to have you both here with us. Nick, let's start with you, and let's start with McDonald's, since it will kick things off, and it's obviously been under pressure as a result of this news of the E. coli outbreak. Shares had been really bouncing this summer, getting some of those customers back who were, intrigued by the $5 meals, and then this. So how big of a fallout, or how much fallout, could there be from this E. coli news?
Well, thanks for having me. I don't actually anticipate there being much fallout. I think they bracketed it very well. They've isolated the incident. And I think it's going to be more like Wendy's in 2020, where it really wasn't much of an impact at all versus, Chipotle. And I actually think more of the focus is going to be on the great results we're seeing from the launch of the Chicken Big Mac and the kind of sales acceleration we've seen quarter to date. So I think the focus is going to be on actually the positives versus the negatives.
Okay. All right. RJ, Starbucks already pre-announced, so the bad news is out there. It was worse than even the lowest expectations, and investors have really been giving Starbucks a pass. I'm curious how long you think this sort of honeymoon period for Brian Niccol actually lasts until investors start to get impatient and want to see some actual, turnaround results versus just plans.
You're right. I think Brian gets the benefit of the doubt right now. I mean, he's led turnarounds at Chipotle, and honestly, I think he's entering a similar situation with Starbucks, where certainly there's some things that need to be done, but it's on a solid foundation right now. If we look at the number of visitors coming in each store, they're still pretty strong. They're down slightly from the last couple of years, but still generally pretty strong, and I think that gives them a good foundation if they can start to build visit frequency. I think they're doing some good things in smaller markets as well, but to your point, there has to be a point where they have to actually show some results, and I think if we start to look early next year, I think that's probably about the right time frame. If you look at kind of his timeline when he was at Chipotle, it really was about 6 months before you started to see more television marketing, kind of refocusing on the brand, and then some menu innovation and some other things. And so I think right now we're still kind of in the learning phase for Brian Niccol. But I think as we kind of look to next year, if we don't start to see some improvement, then there could start to be some questions. But I think right now it's probably better to give him the benefit of the doubt.
All right, Nick, what do you think is priced in at these levels? And do you think that Starbucks has any room to run until, if we have to wait a year or next year for some of these changes to take shape?
Well, I'm on the sidelines for now, and the reason is because we're already seeing a sort of a historical type of multiple on numbers that still have to be proven out. And so I think a lot of the good, a lot of the sort of potential, successful turnaround is already more or less baked in. And, until we actually see some, actual evidence of a turnaround, taking place, it's very difficult to be very aggressive at these levels.
Okay. RJ, we'll also hear from Chipotle this week, Cheesecake Factory. Of the companies that we're expected to hear from, or we're expecting to hear from, what would your top pick be and why?
Yeah, I like Chipotle right now. I think there's a good story. Really, in the fast casual category, you kind of have your haves, which I would say the Chipotle, Cava, Sweetgreen, that continue to do some really innovative things on the product and menu side, as well as the marketing side. Probably a deceleration in comps compared to last quarter, but that was some excellent numbers from in the second quarter. But we're still expecting some nice mid-single digit pickup in traffic, which I think leads to nice comp numbers there. So I think Chipotle is one to watch. Continue to do very well. Even with the departure of Brian Niccol, I think the company's in great hands with temporary leadership, and I think that's a story to watch here.
Okay, and Nick, I was taking a look at your breakdown here. You have an outperform rating and $69 price target on Chipotle, so it's trading, that's pretty close to the highs. It's trading about 12% away from those highs. Do you think that this earnings report will be what gets it there?
I do. At the end of the day, the core itself is going to be fine. I think the quarter-to-date trends are going to point to sort of, slight upside. And long onlys have only a handful of names to pick from that are structural winners. And so I do think that this is a name that's going to continue to benefit from long only interest, not only hedge fund interest, which is kind of what we're seeing with the rest of the restaurant industry. Is the long onlys participate in maybe 4 or 5 names, and the rest are really just solely places where hedge funds are involved. So as long as that's the case, I think Chipotle continues to move forward.
All right, RJ, we have 30 seconds left. I'm just curious, what will restaurant earnings season tell us about the strength or potentially lack thereof of consumers?
I think it's going to tell us it's a very challenged consumer environment where people are looking for deals. I think we're going to see the nice traffic boost early on from the summer with the meal deals that were out there. That'll probably put some pressure on profitability. But the question is, did that sustain? Did we see frequency after that? And so far, data suggests that it's not. So it could be a lot of questions coming out of earnings season.
All right, RJ Hadavi, Placer AI, and Nick Setien, Wedbush Securities. Appreciate your insights. Thanks so much. And thank you for joining us. That's going to do it for the watch list. Download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. I'm Caroline Woods. Thanks for watching. Market on Close is next. I'll see you there.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see pattern. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Taking cues. Set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. It's Monday. We got an hour left. Stock's looking pretty good right now. Nice start to the week. Good bit of risk on across the board. Overnight session was pretty interesting and quite a bit of action in a few spots. So we are off to the races. And it's likely to be a pretty fast moving race this week. There's a lot going on. It's going to kick off without much hesitation, as it looks to be already, with the Russell up 1.5%. That's happening despite a continuation of the bond sell-off. Sometimes the thing that gets in the way of the Russell, oftentimes the thing that gets in the way of the Russell, but not today. So that's showing some confidence. NASDAQ hanging in there after a little bit of a dip, but that's okay. It's still green on the session. And last week it was the strong point. Big tech held us together while the S&P had a down week. So we're off to pretty good little momentum here. VIX still somewhat elevated, but coming in. This week is about earnings. Next week is about the election. This week's also got a lot of economic data too. The jobs report on Friday, but a bunch of other stuff along the way. Look at bonds first, selling off, down 30 bips. Tried to catch buyers early on in the session, then they retreated. Did have some auctions, 5-year, some short-term stuff too, 2-year as well, and the 3-month. So there's a little bit of bond selling going on from the government and a little bit more coming from the market. So 10-year futures now at 110.73, and the 10-year next to the dollar over the last 3 months is up and has recovered all of the downswing around the Fed. Very important, of course, the major macro event of this fall, I guess we should say, is the rise in yields since the Fed cut, and now the dollar's participation as well. Last week, I put the green light on the dollar to get it in line with the red light on bonds, which has been there since the bottom on September 18th. The two now moving pretty well in unison. Tells us that we're probably not going to be getting as many deep cuts as some thought. So we'll probably still get some cuts this year from the Fed, but they're going to have to be a little bit more mindful if the data keep coming in pretty strong. So tomorrow we got consumer confidence, we got jolts, we got some housing data, then we got bond announcements on Wednesday. We'll find out how much they're going to issue for the 10-year on the next sale. We got jobless claims on Thursday, inflation right behind it, and then the employment print on Friday. It is a busy calendar, and now we've done a full swoop in the 10s alongside the dollar. Look at the chart of crude oil next. WTI getting pummeled again and just can't seem to catch a bid. Right now down about $4 at 67.67. The geopolitics not quite the catalyst that many in the energy camp were hoping it to be. Instead, since tensions in the Middle East have been raging, the bond market has been fairly confident. The oil market has been fairly muted. It's just looking like when the U.S. pumps as much crude as it does, and OPEC also aware of that fact, ready to keep some supply on hand, and so we get a very relaxed crude oil market. Now, the higher lows, arguably since the low, add something to the conversation, but I don't really think much, frankly. Crude just can't hold a bid. That's the most important thing. It also adds some real validity to the case for yields rising for the right reasons, which is better than expected data, not inflation out of control again. You just really can't have inflation out of control when you've got crude so subdued. There are plenty of other things that, of course, go into the basket of inflation. Technically, the Fed doesn't even look at the one with oil, but we all know that we all think about it, and it has a major impact on prices overall. So for the sentiment, at least around inflation, it should be fairly relaxed for now, with WTI still below $70. Bitcoin's trying to make a move. Vol coming in a tad bit, but Bitcoin continuing its strength, revving back up after hugging that long-term downtrend line. It looks like it's now using it for support, and that is probably one of the more bullish ways you can respond. The two lines on charts is to break above them and then hold them and then try and use them as support. So Bitcoin's looking pretty good, and if that's any indication for risk appetite, then it should be a positive one. There it is, taken off from the line, and if it's any indication of political leanings, which it might be, then it probably points more towards the TRUMP side of the equation. All right, I got Kevin Hinks and Jenny Hornier with me in studio. This is a pretty darn good start to the week. Kev, you got the Russell ripping despite bonds, which sometimes get in the way of the Russell. You got Bitcoin moving. I mean, it looks like we're ready to put some money on the table here this week.
Kevin Hinks, that's the HINCKS part of the equation.
Yep.
Thank you. I think this is a great start to the week that is only going to pick up pace. Doesn't mean the week's going to end well, but it's certainly starting out pretty well. And I think crude oil has something to do with it, Oliver. I think the fact that energy is down and every other sector in the S&P 500 is up, and surprisingly leading, financials of all.
You love it, right? Don't you love to see that?
I think that's a great signal, great green light for the rest of the economy.
Heck yeah.
It tells you that the
Kevin Hinks on the risk radar. Love it. Green lights, baby.
Green lights. I'm going. Wow. Yeah. So I think so far so good, and I think the financials leading is a good sign. And I think, remember, energy, crude oil getting hit is a return to the macro discussion about crude oil and away from the geopolitical concern about crude oil. One's fading away, which the other one seems quite heavy on crude oil.
Arguably also, if any indication, crude oil on the geopolitical side that we've sort of, I mean, I don't know, I say this with the biggest grain of salt in the world, but like avoided, the worst of the situations possibly.
Right.
But, whenever there is tension, there's a lot of saber rattling goes on. There's a lot of speculation that goes on. There's a lot of energy experts who then become politics experts. Right. And in this case, nobody, none of them, not a single one, when Israel and Palestine started going at it, back in August or whatever, said that we were going to be below 70 right now. So that to me also kind of puts some of the risk in the background.
When geopolitics comes rushing to the front, macro goes way to the back. They don't care about the macro. They care about political risk and they care about disruptions. And when the disruptions don't happen, you got to go back to the macro. And the macro's not setting up well. More supply, less demand. It's kind of a pretty bad relationship right there.
I feel like it's the same camp of people though that called for like World War III.
Always.
And I don't understand that because I don't understand the doomsday rhetoric because then we trade down on it and then it never happens.
Yeah, that's exactly my point, which is that crude people,
the market loves to go to the worst case scenario first.
Relax. They're always inserting all these negative, toxic ideas in our heads. And then the market says it doesn't really matter right now.
Yeah, I put a big yellow on them on my risk radar.
There you
I
go.
think it's unique I think it's unique to the futures space.
Right.
They love to go to the worst case scenario first, then worst.
Totally. Yeah.
I think it's the same.
I see it in grains.
I think you see it in Bitcoin too. I know that doesn't trade like that right now.
Yeah. Gold bugs too. But all right. Right now, though, everything basically is working except for WTI. Every sector, every stock, every style, value companies. To Kev's point, the banks are leading. The tech stuff obviously is going to be our highlight this week, though. There's a few interesting stories out here. Jenny, one of them, I guess, is more details on what Meta wants to do with their AI. And I will say that it appears they have been maybe the most disruptive ones so far in inserting AI. Now, I've seen their AI on I guess Facebook, maybe.
Do you go on Facebook?
Just to sometimes message my grandma.
Oh, okay.
What a no offense, Kevin.
I was going to say, that hits awfully close to home.
But yeah, they can...
You're talking to my age demographic now.
They'll have a clip or something. They'll say, do you want to know more about this? And then so they've kind of integrated in a way. But anyway, so what's the report? What are they saying?
Okay, so they're releasing this AI-based search engine as they look to reduce, obviously, their dependence on a Microsoft's Bing or Alphabet's Google. The AI search segment is heating up as we do see that, also the ChatGPT maker OpenAI, as well as Google and Microsoft are all vying for dominance. And plus, Meta's right now will have this more conversational answers to users about these current events on Meta, as well as their chatbot, WhatsApp, Instagram, and Facebook. So I think that this is actually huge because it's very useful AI. I was doubting, I guess, your familiarity with it because you don't have Instagram anymore, right?
I don't use Instagram.
It's wonderful for Instagram.
Nope, don't use Instagram, but I do use WhatsApp, which is Meta owned, and then to check in on the family for Facebook, which, by the way, shout out, Grandma, 88th birthday. Love you.
Today?
Today.
Today.
Absolutely. There you go. So there we go, lo and behold, as we talk Facebook.
Well,
so
happy birthday, Grandma.
I'm sure her wall is blown up with some birthday wishes right now.
I know. No one's wall is actually more popular than my mom's. It's like that she is in that target demographic.
Yeah, Grandma owns Facebook.
Yeah, that's like my mom as well. But I think that this is big, especially as we know that right now Alphabet's really trying to boost its offerings with like Gemini, which also is wonderful. I mean, I'm a huge Google user. I think I Google everything all day long, and
absolutely
the way that it now like basically like gives you every summary of like what you just searched so quickly in a query is wonderful. So
it is, yeah.
Both of these companies, I'm like, this is where AI, you cannot doubt how much easier it makes your life, especially for someone that like researches all day like we do. It's wonderful. I see this only aiding. Does this mean that you're going to like attract new user growth? No, Meta's fairly saturated right now, but I do think that then it does aid another argument of like, what are they doing with all the money they're spending? Because they're ramping up as substantially as anyone in terms of like their capex, which we'll get obviously more clarity on Wednesday.
Yeah, that's kind of a good question for this earnings season also, Kevin, which is, do the Meta, Alphabet, hyperscaler capex reports act as a like proxy NVIDIA catalyst in a way? And do you think the market wants to see those numbers go up still?
Yeah, it's interesting. All the AI spending leads to NVIDIA. But Amazon, if you remember last quarter, they didn't like the CapEx spending out of Amazon. They hit that stock hard after their earnings because of the spending, because going back to their history, the stock traders around Amazon don't like when they spend, and all of a sudden the next quarter they don't spend and the stock recovers. So I think that's a big, CapEx is going to be a big part of this. Think about it, this week we're going to cover just about all cloud. Amazon, Microsoft, Google. That's the lion's share of cloud going to be covered this week in earnings. Oh, yeah. So I think there's so many stories, it's hard to figure out how to fit all of them in one day.
To me, I think the ranking is Apple and Meta at the top because they're the best performers.
Digital ad spend.
Right, so they have got to have the highest bar just because they're closest to the highs. Apple also at its record valuation, really interesting chart for Apple. What's the tone with the AI rollout right now, Jenny?
Okay, so it just came out. I need to actually like download it. My Wi-Fi is too poor in this office to do so, but I need to do some deep diving into like actually how this impacts my life. I've been complaining about the fact that this wasn't on the initial rollout of the 16 for so long. I think I have to do my own due diligence, but I do have the 15 Max Pro or whatever that gives me access to it. So I will
so you can get it. Yeah.
I can get it, and I will be giving you more of a full workup tomorrow. But right now, I think at least huge that we were able to get that on time, because I feel like that was a question of like the 18, when will we actually see this roll out? But it's here. So I need to try it for myself to see if it's life-changing like we thought it would be.
My younger children are Apple geeks, and they insist the reason they didn't do it because they didn't want to disrupt the normal September release of the phones, which is historically when they do it.
Okay.
And that's why they had to do the phone, then the release.
That's a good
Seems
point.
like kind of a big, well, it's also just like pure software basically, so you don't have to have technically a new phone to, I guess arguably if it's better, it can handle it more. But like, again, I've had my Pixel for, I don't know, 2 years, and they just put Google Gemini on there, and I can get all whatever I want from it. Basically, is ChatGPT.
From Gemini on my phone.
Yeah, it's pretty good. It's pretty helpful, actually. Apple's AI could use a little more smarts, and it still has a lot to learn. That's The Verge's review of it today. Thanks, Jenny. Thanks, Kevin Hanks. Yeah, so, all right, it's going to have to educate itself. Vincent Dillard joins us for our macro discussion. He's the director of global macro strategy at StoneX Group. Afternoon.
Last 5 minutes of trading. Where were you? Where were you? Where were you? 3 minutes left. They buying it. Buy it. If you like it, you should buy it. If you like it, you should buy it. Buy it. Are they scared for that person? Hey. Don't fight it. Can't fight it, boys. This is big money, man. It's just good money. It's just good money. 2 minutes left. Just good money. It's just
Spring,
good
but is not
money.
on 3M to 165 from 160. And while the company has gone through this massive transformation, multi-billion-dollar settlements over toxic chemicals, restructuring, spinning off healthcare, Tusa saying that he's bullish on 3M's new management at the helm.
A lot of this is driven by productivity, restructuring, price cost. So if they get any revenue growth, anything north of like 3%, that's all gravy on top of what we're expecting.
The question is whether focus on change and restructuring pivots to real earnings growth. 3M has had a tough 24 months, but since the healthcare spinoff in April, the stock has rebounded sharply by 46%. Average price target on Wall Street, Scott, is $149 a share. I'd point out the stock is trading at $130.
All right, Seema, thank you. Seema Modi with the update on 3M. Mike Santoli joins us now for his own last word of the day. Pretty good day as we're about to get hot and heavy on these earnings and the jobs report at the end of the week.
It's been pretty good. The S&P 500 just sort of hanging in there. It's this low momentum move. For 2 weeks it's been sideways, but picking stocks starting to get over, picking spots rather, starting to get overexcited. I mean, banks up another 2% today as a group. Small caps got this bid. Also watching for areas that are just looking a little bit jumpy and have all that hot money flowing in, like GameStop's up 10% today. DJT is kind of a meme stock. Bitcoin may be breaking out. So it's odd. The overall market is in wait and see mode. Let's see if yields break to a scary place. And you also have, though, this sort of retail money that maybe suggests people are getting overconfident in certain themes in the short term. So all that in the mix. The earnings are really going to overtake whatever those things are going on from here, as well as the bond market response to data the rest of the week.
All right, we're going to ring the bell. We're going to be green across the board. And 24 hours from now, we are going to start delivering those mega cap earnings. Alphabet's going to kick it off and continue to cover that huge story of what lies ahead for stocks into OT with Morgan and John.
That's the end of regulation. Walmart ringing the closing bell at the New York Stock Exchange. Data.io doing the honors of the NASDAQ. Well, the major averages closing higher. The small caps getting a big pop as a huge week of earnings and so much more gets underway. Energy finishing in the red, though, after oil saw its biggest drop in years. That is the scorecard on Wall Street. But the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Ford.
Yeah, coming up this hour, earnings results from Ford, Cadence Design, VF Corp, and F5, along with exclusive comments from F5 CEO before the earnings call.
And we will talk to Ford's chief financial officer exclusively ahead of his conversation with Wall Street analysts as well, as investors look for signals on the company's EV strategy and more. But as we await all of those results, let's bring in our market panel. Vital Knowledge founder Adam Crisafulli and RBC Capital Markets head of U.S. equity strategy, Lori Calvasina. Great to have you both here. Adam, I'm going to start with you because I realize earnings are going to really
pump up a notch here as the week unfolds. We also get a lot of economic data and all of this ahead of the election next week. What really seems to have moved the markets today was the move higher that we saw in yields in the Treasury market and everything that factored into that, including this fall in oil. It seems like Middle East and Japan, I guess, is the bottom line, that it was global dynamics feeding the U.S. markets.
Yeah, I think for today, investors saw over the weekend, you had two macro developments that were received well on equities, one of which was the Israeli retaliatory strike against Iran, which was considered to be somewhat de-escalatory, and so oil saw a pretty steep decline. And then in Japan, there's the thought that the political turmoil there will make the BOJ proceed, and it will temper some of its hawkishness as it considers further tightening steps. So somewhat positive for U.S. equities, but neither issue was really, I think, the central concern for stocks, particularly U.S. yields, which have been moving up largely because of, I think, increased concerns around just some of the giant fiscal obstacles that are lurking on the 2025 calendar. And obviously next week's election will play a big role into kind of how some of those things unfold. You also had a couple of underwhelming auctions today that contribute to the move up in yields as well. So, you still have this dilemma. On the one hand, macro conditions right now are very favorable, resilient growth, disinflation, stimulus, and then relatively healthy earnings. But you have expensive stocks, and then you have this yield dynamic that's acting as a headwind as investors kind of really start to try to figure out what's driving yields up. If it's just data and inflation and concerns that the Fed will be easing at a slower pace than anticipated, then I think the move in yields is overdone and stocks can absorb that well. If this is concerns about ballooning deficits and debt and a lack of any type of real effort in Washington to tackle either of those, debt ceiling expiration, shutdown risk, all those things, if that's what's driving yields, then it's kind of a much bigger concern. And that's kind of where we are right now. We've been moving sideways now for several weeks because of these two countervailing forces.
Yeah, it's a real wall of worry for investors to scale here. We have Cadence Design earnings out. We're going through those results, and we'll get them to you in just a moment. In the meantime, Lori, we've got, speaking of earnings, 5 of the 7 Magnificent 7 set to report this week. We know that of those names that are set to report jointly, they account for 23% of the S&P 500's weight. So what can we extract so far from earnings season, and how much now hinges on results we get in the coming days?
So thanks for having me. Look, I'm not going to lie. I didn't love the tone of the reporting season last week. I think the stats were all fine, but just not quite as good as what we'd seen in 2Q. We got deluged with industrial companies, and maybe I just read too many of those. But things came out as, sort of pretty mixed. I think when we think about kind of these Mag 7 names that are coming out, they have 2 critical pieces of importance. One, just the health of the broader market, but 2, the health of the rotation trade. And that's where we continue to see a lot of investor interest. Those Mag 7 companies have been dominant on forward-looking earnings growth, but their dominance has been slipping just a little bit relative to the broader market. But the way I describe it in my meetings is I think the rest of the market, S&P X Mag 7, they're just not stepping up. They're just not seeing the kind of improvement in forward-looking earnings growth expectations that they need to see to really, have that rotation be smooth sailing going forward. So I'm really going to be looking for kind of the numerator and the denominator, how the Mag 7 earnings growth expectations are shifting and how the rest of the market, and whether the rest of the market, frankly, is able to, kind of start that process of catching up. So far, to be honest, they're kind of whiffing.
Okay, well, one that's not whiffing, Cadence Design. Those earnings are out. Let's get to those. Julia Borston has them with that stock up nicely in overtime.
John, Cadence Design digging both the top and bottom line, reporting EPS of $1.64 adjusted versus estimates of $1.44, so a 20-cent beat there. Revenues of $1.22 billion, coming in ahead of estimates of $1.18 billion, and the company raising the midpoint of its 2024 EPS outlook to $5.90. The company is saying in its release here that their fourth quarter bookings pipeline looks exceptionally strong, saying we are well positioned to deliver a strong 2024. And you see the stock is now up nearly 10% in after-hours trading. Back over to you.
Okay, Julia, thanks. Now let's jump over to Phil LeBeau for Ford earnings results. Phil?
John, this is a beat on the top and the bottom line for Ford in the third quarter, earning 49 cents a share, 2 cents better than what the street was expecting. Revenue coming in at $43.07 billion. The street was expecting just under $42 billion. And then let's look at the metrics. Remember, Ford breaks out the 3 business divisions: commercial vehicles, internal combustion, and electric vehicles. Commercial vehicles, that's been the profit driver all year long. They earned $1.81 billion in the third quarter. ICE, the internal combustion engine vehicles, earned $1.62 billion, and another quarterly loss for the electric vehicle business, this time $1.22 billion. When you break it down over 32,000 vehicles sold, the average loss per electric vehicle in the quarter, $38,250. That is an improvement compared to previous quarters. Free cash flow of $3.2 billion, Q3 EBIT margin of 5%, and then the guidance, there is a little bit of a change here. The 24 EBIT guide for the full year, earnings of approximately $10 billion. That's on the lower end of the previous guidance, which was $10 to $12 billion. Free cash flow remains the same, approximately $7.5 to $8.5 billion. And the commercial vehicle EBIT guide is approximately $9 billion. Internal combustion engine vehicle EBIT guide was approximately $5 billion. That's a big cut compared to previously. It was supposed to be $6 to $6.5 billion. And for the full year, they expect to lose approximately $5 billion when it comes to electric vehicles. Don't forget, we are going to be talking with John Lawler, CFO of Ford. We'll be talking with him in just a few minutes, even before the analyst call, guys, as Ford beats on the top and the bottom line for the third quarter. Back to you.
Oh, I didn't forget. Looking forward to that, Phil LeBeau. Meantime, F5 earnings are out, and F5 reporting fiscal Q4 results that beat consensus on the top and bottom lines in a Q1 guide that's above the street on revenue, in line on EPS. You can see that stock is up 9% initially. Okay, so Q4 revenue for F5 for application delivery company, it came in at $747 million. That's above the $730.
Ready to do the next part? All right. We're gonna pause. All right, ladies and gentlemen, looks like the show's over. Round to a halt. Tomorrow we end up at 999. All right, we right at 10, so right at 10. Right on the money. Somebody want to buy something. Come back.